unemployment rate doesn't really spike, because unemployment rate is a function of both the labor force supply. So migration has a big impact on it. We expect an unemployment rate to tick up, but not spike. So we put all those things together. We think there's a good case for Fed not to cut this year, but having to cut a lot more next year.
So I understand long duration is the play here. How come not just buy the outright 10-year?
No, I mean, we're not, absolutely, we would be recommending that as well. Our expectation is 12 months from now, 10-year Treasury will be in around 345. So it's a pretty substantial rally. Yep. In fact, our big case for fixed income in general is really the duration rally. So it's a 100 basis point rally in 10-year Treasury, roughly. And that's a pretty significant uptick.
Just to put some underscore on this, are you saying that all the people saying, sell 30-year Treasuries, short 30-year Treasuries, guess what? This is going to be absolutely the risk asset. You're taking the other side of that?
So what we are saying is that what will eventually matter is how the growth expectations and the policy response, the Fed's response to those growth expectations, we think currently they are off. And if the policy turns out to be the way we are anticipating it to be, we think duration is a good bet.
So buying 30-year yields.
The 30-year yields is a
2026. No one wants to do it.
No, I don't want to do it. I mean, it's a 2026 trade as opposed to 2025 trade. So best opportunity for buying the long bond would be later in the year, early next year, as opposed to now, when some of the uncertainties that surround us, we would have seen hopefully some of those things will be clear.
Vishy, we're going to have a special hour devoted to not just this, but also your argument on cricket, which I know you devoted a lot of time to come in here and defend it from the ruthless attacks from baseball lovers last time you were on. Vishy Tirupattur of Morgan Stanley, thank you so much for being with us. Honestly, I just have to say thank you, Tom Kennedy. Thanks you so much. And thank you so much, Damien. Thank you. Do you want to come back tomorrow and do it again?
I think I am.
Oh, that's fantastic. I'm very much excited. So Damien's going to be with us coming up tomorrow. Also, Savita Subramanian of Bank of America, Kate Moore of Citi, Jim Caron of Morgan Stanley, and EU Commissioner Valdis Dombrovskis. Don't miss that, as a real question emerges about how close the U.S. and Europe are to a trade deal. This was Bloomberg Surveillance.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit. Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season? On the road. we're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows, up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Markets in a risk-off mood again this morning after a turnaround yesterday. 30 minutes until the start of cash trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, Trump's team pushes for trade talks with China as the president presses reluctant Republicans on his multi-trillion-dollar tax bill. And Wall Street titans are gaming out how to profit from this policy uncertainty. We'll hear from AQR's Cliff Asness as well as Marathon's Bruce Richards in this program. Plus, the Texas Stock Exchange challenges the NYSE and the NASDAQ. We'll hear from the man helping lead the charge, former Congressman Jeb Henseling. Katie, what are you watching?
Well, it's still earnings season, so I have my eyes on Dollar General, out with a beat and a raise. The retailer easing tariff concerns, with the CEO saying that they're uniquely positioned to serve customers in a variety of economic environments. Obviously, traders seem to like that. The stock is up about 10% pre-market, Matt.
Wow, big boost there. We're also watching Meta, the owner of Facebook, buying nuclear power from Constellation Energy as AI sends power demand soaring. You can see Facebook shares right now, little change in the pre-market, but Constellation up more than 11%, Katie.
And on the policy front, President Donald Trump still pushing for Senate support of his big, beautiful tax bill. The president wrote on Truth Social yesterday that, quote, what nobody understands is that it's the single biggest spending cut in history by far. There will be no cuts to Social Security, Medicare, or Medicaid, a key flashpoint in the debate. Former acting chief of staff Mick Mulvaney had this to say about the process.
The Senate is under no way, no circumstances, ever going to accept what the House sent without any changes. So this is just round 2 of at least 3. I think, as Linda, that this July 4th date is completely artificial. The important date is this. Buried in this bill is the increase in the debt ceiling. Scott Bessent has said that the Treasury runs out of money, I think, effectively sometimes in mid-August. That's the real date here. That's the hard deadline.
Let's get the latest from Bloomberg's Washington correspondent, Tyler Kendall. She is at the White House. So, Tyler, what do we know about how powerful the president will be in convincing these senators to vote for his one big, beautiful bill?
Yeah, hey, Matt. Well, he's definitely starting to ramp up the pressure on these senators, hosting a sweep of calls last night to some of those key holdouts that say they are threatening not to vote for the bill unless they see their demands met. And there really are conflicting demands here. On one hand, you have this group of Republicans pitching themselves as fiscal hawks, perhaps led by Senator Ron Johnson of Wisconsin. He's one of those senators that did get a call last night. He wants deeper spending cuts and has taken issue with claims that new tax priorities, like no taxes on tips or overtime pay, really incentivize growth. On the other hand of this, though, are those Republicans that are raising concerns about changes to benefit programs, such as Senator Josh Hawley, another senator who got a call last night. Of course, this is a politically fraught issue for the White House when it comes to changes to Medicaid. And as you read at the top of the segment, President Trump is pledging that ultimately there will be no cuts to Medicaid. But there's a few different analysis out there, including one cited by Bloomberg News, that shows that 7.7 million people by 2034 could see their coverage lost due to shifting eligibility requirements. Now, I could keep going. This is, of course, one big, beautiful bill, so there's a lot of disagreements in here, but I would also pay close attention to what happens on the tax cut front. There are some senators that want to make some of the temporary provisions permanent. And then lastly, Matt, since I know you watch this closely, there's some disagreement about the SALT cap. We had Senator Kevin Cramer on Balance of Power last night. He suggested that a sweet spot for that cap could be between $20,000 and $30,000. Of course, that is lower than the House plan of lifting it to $40,000.
And that is certainly not good enough for Matt Miller, and July 4th is quickly approaching, so...
Or any of those who are in favor of states' rights. This is a states' rights issue, and I think a lot of people forget that, right? The idea is if you cap the state and local tax deduction, you're centralizing power, pushing it towards the federal government in Washington.
Well, we only have like 2 minutes left with Tyler, so I have to ask you about China because we played a little bit of Mick Mulvaney at the top here. Something else he said was about the concept of a President Trump, President Xi phone call, which we talked about yesterday, Tyler. He said that there's a fundamental disconnect here. Trump wants to talk at the very highest levels. That's not always how the Chinese want to do business. So, Tyler, it seems like we're in a little bit of a standoff here when it comes to actually getting these two on the phone.
Right, it really does feel like a holding pattern, and key to Mick Mulvaney's comments was that line that you highlighted, a fundamental disconnect, since we know that China really would like to see key advisors iron out the details before they put Xi Jinping on the phone, and it does seem like some of those key details continue to mount here. The other part of this is that there's just so much uncertainty, and we know that's something that China doesn't really want to put their leader in a position of getting on the phone with President Trump when there still isn't really exact clarity on what this White House needs to see in order for a deal to get done. Now, I mentioned this yesterday on this program, but I did have the chance to catch up with the Deputy Treasury Secretary, Michael Falkender, who told me on one of those issues, eventually, it really is going to come down to a phone call between the two leaders, and that's when it comes to the U.S.'s accusations that China is slow-walking those export licenses when it comes to critical and rare earth minerals, saying that that's going to be one of those top priorities that these two leaders do need to discuss. The White House, it's clear, thinks that that's one of those issues that could be resolved in that way.
All right, Tyler Kendall, great reporting as always. We'll be checking in with you again very soon. But let's turn to the corporate front here because Constellation Energy has reached a deal to sell nuclear power to Meta. Meta plans on using the energy to run its data centers. You can see the news powering nuclear stocks higher pre-market, including Constellation, up about 12% at the moment, and the whole sector as well. Let's break it down now with Bloomberg Power and Renewable Energy editor Will Wade. So let's start with the logic of this deal here. This is a 20-year contract. It starts in mid-2027. So clearly, Meta plans to use this power for quite a long time.
Oh, yes. We're seeing so much demand for energy from all the big technology companies. They've got data centers that need more power than ever before, and they're building so many. The demand for electricity in the U.S. has pretty much been flat for decades. And then all of a sudden, about a year ago, it really started to jump. So this has caught the energy industry kind of flat-footed because it takes a long time to build power plants. They're big facilities. So for Meta, this is like a facility that exists now.
So we didn't get the financial details. We don't know how much they're paying, right?
No, and don't think I didn't ask Joe Dominguez, the CEO of Constellation.
I'm guessing you can kind of ballpark it from the Microsoft deal, but
yeah.
My other question, aside from how much, is does this push Constellation to open up another reactor there?
They're talking about it, and that's really significant because we haven't had a new nuclear power plant in the U.S. in a long time. We had the Vogtle plant that was finished last year, and it was like 7 years late. It was billions of dollars over budget. And I went down there for the grand opening, and there were all these people saying, let's do another one. You know who wasn't saying that? Southern, the company that lost a ton of money trying to build it, because nobody wants to be on the hook for the costs. So what I've been hearing ever since then is we'd love to build a nuclear power plant if someone else will make sure that they'll pay for it. Tech companies have big money.
All right, Will, thanks very much. Bloomberg's Will Wade covers this stuff, and as he said, he goes to these plants. He braves the radiation to bring you the news that you need. Staying, though, in the land of big tech, Microsoft eliminating 300 more jobs just weeks after cutting thousands last month. Disney also announcing job cuts. Here with more is Bloomberg technology co-host Caroline Hyde. And Caroline, 300 is not a huge amount, relative to the rest of Microsoft's workforce, but what's going on here?
Well, you need a lot of power for AI. You don't need so many software developers and engineers, it seems. And so actually, when we saw 6,000 people cut from Microsoft, that was announced back in May, a large proportion of those people who were said farewell to are indeed development engineers here. And that's because we're seeing Satya Nadella, the CEO of Microsoft, say we are doing about 30% of our coding now via artificial intelligence. So everyone's trying to rework their workforce, whether that means you need fewer software engineering talent, or that means you actually just need to go out, goodbye to the old, in with the new, reorientate yourself. Look, we heard similar things coming out of Salesforce. So as they gave us their numbers last week, we heard that they too are perhaps not having to hire at the same pace as usual. They're able to slow hiring, and instead they're beefing up the sales department because they've actually got all the product, and now that they're able to start selling a little bit more rapidly. But this is really being echoed across the technology front. You're seeing people get leaner and leaner and focusing more on putting money on the energy side, the infrastructure side, and just developing the AI product. But for that, perhaps you need fewer people.
And it's interesting to note that we're having this conversation ahead of 10 a.m. JOLTS data when it comes to job openings. And of course, the payrolls print on Friday. You mentioned that you're seeing this across the tech industry, but it's not just tech. We got some interesting news from Disney yesterday, also planning to lay off several hundred workers, and they've laid off really thousands of positions in recent years.
I think it's about 8,000 have gone in recent years from Disney. Now, this is, again, not large when you think about 250,000 people that Disney currently has under employee base, but they are shedding a couple of hundred, it seems, once again in the content side. So we're thinking marketing, you're thinking just the way in which you're going to go out and promote movies and content. They're slimming down there once again because times are tough. They want to make fewer movies, get more bang for their buck, and we know what's happening to content, the amount of shakeups that are happening at Comcast, the way they're selling off MSNBC and CNBC. You've seen, of course, Paramount thinking about its own costs and being leaner. Warner Brothers has done a big overhaul as well. So this is, again, a restructuring vibe. And when you just think across the whole plethora here of technology and content, people are just trying to reorientate their workforce for a future. I go back to Microsoft saying, look, the spokesman saying we continue to implement organizational changes necessary to best position the company for success. It's a dynamic marketplace.
Well, it'll be important to see when all of these stories that we're talking about individually start to show up in the overall economic data. Great roundup, Caroline. That is Bloomberg Technologies' Caroline Hyde. And be sure to tune in tomorrow as the Bloomberg Tech Summit gets underway in San Francisco. We'll hear from industry leaders, including the CEOs of Uber, Rivian, and Peloton. Caroline and Ed Ludlow will have a special edition of Bloomberg Technology live from the event on Thursday at 11 a.m. New York time. Certainly don't want to miss that one. But let's take a quick check on these futures right now because those pre-market losses lessening right now. The S&P 500 down just 0.1% about 20 minutes ago until the bell rings. We saw something similar yesterday, really pre-market losses, and then American investors woke up and started bidding up stocks. So we'll see if the same pattern holds true today, Matt Miller.
Yeah, I mean, yesterday we had NVIDIA, attempting to lift the market. At one point, you were checking stocks, and 400 were down, but NVIDIA was up, and that was enough to bring us back. And by the end of the day, of course, that breath turned around as well. Coming up, Dollar General is raising its outlook on hopes that shoppers will look for more deals, specifically there at Dollar General. Those details next. This is Bloomberg.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
All right, let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence
from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Let's get now to high interest and look what's making headlines around the world. NATO is asking European member states to expand ground-based air defense capabilities fivefold as the alliance races to fill a key gap in response to the threat of Russian aggression. The ramp-up will be discussed at a NATO defense minister gathering on Thursday. The alliance is already planning on boosting its weaponry and air defense systems as it scales back reliance on these United States of America. Elon Musk is selling $5 billion in debt for his artificial intelligence startup XAI. It's the latest in a series of fundraising efforts across his business empire as Musk pivots away from politics and returns to running his various companies. Morgan Stanley is shopping the debt for XAI with a double-digit interest rate. The financing could help Musk spend aggressively on AI infrastructure as he builds out a massive data center in Memphis. And JP Morgan is putting Marianne Lake, one of the leading contenders to one day take over for Chief Executive Officer Jamie Dimon, in charge of strategic growth in the firm's fastest growing overseas consumer bank. The appointment follows the departure of Sanoke Viswanathan, who's leaving to become the CEO of data company FactSet. Lake has been serving as the CFO at JP Morgan. And let's get some breaking headlines right now from Ford. Electric vehicle sales in the month of May have fallen 25% from the same month a year earlier. Meanwhile, all U.S. auto sales rose 16.3% in May, and that's due to strong truck sales, which is pretty much the main thing Ford sells, Katie, aside from the Mustang platform.
There you go. Really interesting news about the EV sales, though. We'll continue to follow that story. But let's switch gears here and talk about Dollar General. An interesting earnings report out this morning with the dollar store showing that it can manage the Trump administration's trade war. The firm also raised its annual guidance despite heavy exposure to China and a slowdown in shopping trends. The CEO just saying now that they are seeing more high-income customers. Bloomberg retail editor Emily Cohn joins us now to discuss. And I want to focus on that last part, the CEO saying that they're actually seeing more high-income consumers coming in and shopping at their stores. What does that say about the economic environment that we're in?
Well, these types of stores, dollar stores in general, tend to do well in these types of environments. We see low-income shoppers coming, but also higher-income shoppers trading down and coming to Dollar General. So it says that shoppers are feeling squeezed and coming to Dollar General because they know they can get a bargain.
It's interesting. I can imagine high-income shoppers trading down to Walmart.
Yeah.
But I feel like trading down to Dollar General is maybe like a consumer cry for help. Is that?
That's true. Dollar General also has this, their footprint advantage. So we're talking about rural shoppers here when we're talking about Dollar General. That's their real advantage. In lots of areas of this country, the closest store where you'd go out to get a gallon of milk is going to be a Dollar General, and that's their real advantage here. Looking forward, this battle for the rural shopper is a big area that we're looking at. They're getting more competition from Walmart and Amazon. And these rural shoppers are really where the battle is heating up.
It's a great point on the geography that we're talking about here. We're getting some other comments from the company saying that it expects some price increases from tariffs. They've managed to navigate pretty well thus far, it looks like, looking at their results, but talk to us about their exposure to China.
So they're in a good spot relative to their competitors because a bulk of their sales come from consumables, groceries. Those things tend to be less exposed to tariffs than the other aisles of the store. So they, in this report, they said that they took into account current tariffs rates, and they actually raised their guidance a little bit. So they have an exposure to China, but I think it's something that they can mitigate, and that's why the stock is up this morning.
Right, mitigating that in part by raising prices.
Yeah.
All right, really interesting stuff. Thanks so much for joining us. Emily Cohn covers retail on the BN side of the building. Coming up, BlackRock's Gargi Chowdhury says the banner month for markets in May was masking dispersion under the hood. We'll ask her what that means next on Open Interest.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet. Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
We've all seen what's happened with the VIX and volatility in the equity markets this year. This will not be a calm market. The market is expecting some sort of resolution or some sort of progress. If they don't get that progress and we go the opposite way and we start putting in more and more tariffs and not making progress, we're going to have a problem.
And that was Wells Fargo strategist Chris Harvey, who holds the title of the biggest bull on Wall Street. Meanwhile, you have Deutsche Bank lifting its S&P 500 target as markets recover from trade shocks. Specifically, the firm lifted its year-end forecast to 65.50 from 61.50. That implies a 10% gain from Monday's close. Joining us now at the desk to discuss it all is BlackRock Chief Investment and Portfolio Strategist of the Americas, Gargi Chowdhury. Gargi, great to see you in person.
It's good to be here.
So I know that you don't have an S&P 500 target, but I'll ask you the same thing that I asked Stuart Kaiser 24 hours ago, which is If you did, would you be lifting it right now?
So it depends on when I set those targets.
Right.
If we did that, if we had set it on April 3rd, then perhaps, yes, we would be lifting it. Because obviously, over the course of the month of May, we've received a lot of positive data, not only on the tariff negotiation front, but on the earnings front. And that means something. We're also seeing that the soft data perhaps is lifting from the terrible levels that it had gotten to in April and May, and the hard data so far remains okay. So depending on when people set their targets, I think there are some reasons to be a little bit more optimistic, and I think it's all related to earnings. Having said that, we haven't seen we haven't gone back to the Feb 19th levels because there are some reasons for that too. Growth is slowing down. We have to be cognizant of that, and we're questioning whether we can get those Fed cuts that are priced into the market.
That's right. Earnings estimates are lower than they were in February, lower than they were on April 2nd. And we had the OECD, for example, come out this morning and say, we don't expect 2+% growth anymore for the U.S. Now it's 1.6%. How much does the Fed need to cut, and are they going to be able to do that if we don't get some clarity on the tariff policy of the United States?
Yeah, that's exactly the right question, Matt. I think when you look at what's priced into the market, give or take 2 cuts, I think it's a probability-weighted outcome. So if things get really bad, and by the way, the chances of a recession coming through by the end of this year, those chances are dropping from where they had gotten to, right? Many people are pulling back their expectations of a severe slowdown. But for example, if there were one were to happen, you could see 3, 4 rate cuts. At the same time, if we're fine, if the labor market, as we might find out later today and through the course of this week, if the labor market remains resilient with no massive job destruction, I think the Fed doesn't need to go at all, or maybe just once towards the end of the year. So the probability-adjusted outcome of those two look like about 2 rate cuts. Do they need to go if inflation is sticky and growth still lower, but still about a 1% level? I would say maybe just once.
All right, Gargi, you're sticking with us through the opening bell. We'll see you on the other side of this commercial break. Let's take a look at the setup as we count down to the ringing here. You can see the S&P 500. It feels like it wants to go green. We were looking at much steeper pre-market losses just a few hours ago, but right now down about 0.1%. The NASDAQ 100 is already there, pretty much flat, but the color is green. But it's the small caps out in charge, Matt Miller. The Russell 2000 up about 0.4% with about 4 minutes to go until the open.
Wow, we still look at the Russell 2000.
And we should.
We're going to continue, right? You're going to keep that on the board?
Until they drag me off the set. A price-weighted index, can you imagine?
You know what? We'll change it on the World Equity Index screen as well. We'll replace the Dow.
Thank you. I appreciate that.
The Russell 2000. Coming up in just over 30 minutes' time, we're going to sit down with Cliff Asness. He is, of course, the billionaire founder, co-founder of AQR. He's going to tell us how his firm has gotten double-digit returns even amidst volatility. This is Open Interest.
So important to you? It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
We are moments away from the start of trading on this Tuesday after a turnaround. Yesterday, it looks like markets are struggling to push higher. Again, you can see S&P futures right now down, but only 0.06%, and we were off much more at 3 o'clock this morning when I came in. NASDAQ futures are also very little change right now, but the Russell futures looking good, Katie. In terms of the opening bells, you've got OLO right now ringing the opening bell on the New York Stock Exchange. They're down 60% over the past 5 years, so I feel like they can do better for their shareholders. On the other hand, SS Innovations, surgical supply company, they have more than doubled in the past 5 years. In fact, they're up 114% with all dividends reinvested. So
there you go.
They've done pretty well. Dollar General's doing well today. What do you want?
Doing pretty well. This is the last gasp of the current earnings season, and it's Dollar General out with a beat and a raise. The retailer really easing those tariff concerns. You have the CEO saying that they're uniquely positioned to serve customers in a variety of economic environments. We also heard from the CEO saying that they're seeing higher income consumers come into their stores, so really benefiting from that trade down that we're seeing. Matt Miller currently up about 11% just minutes after the bell.
And Meta, obviously, is one we've been talking about this morning. Buying nuclear power from Constellation Energy as AI sends power demand soaring. But the 20-year contract doesn't start until the middle of 2027, which seems like
a lifetime away.
Right? That's a long way from now.
We'll see.
We'll be past the midterms. It could be a whole new world.
Life could look totally different.
All right, we're back with Gargi Chowdhury, BlackRock's Chief Investment and Portfolio Strategist for the Americas. And Gargi, obviously AI and power was everything last year. Is it everything again this year?
I think it is. I think it can be. When we look at what drove much of the market performance from the April 2nd lows, a lot of that is coming from the earnings power and the earnings growth we've seen in the large cap quality companies, many of those that have a software or AI theme associated with them. Every time, we're all as market participants wait for NVIDIA earnings, we continue to be amazed by the revenue growth. We continue to be amazed by how much all of these larger companies are investing in CapEx. And that is a big driver of growth for the United States going forward. So I do think this will be a mega trend, a mega theme that will be with us for 2027 and beyond. And now I think it's broadening to areas such as power, such as one of the things that we talk about in our outlook around software. And I think that's with us to stay for some time.
This is a question that I've been asking, it feels like, for the past year, and I've probably asked you this question before, but you mentioned that now maybe we're talking about software. It feels like so long the AI trade has been the enablers, it's been the picks and shovels, the NVIDIAs of the world, but it seems like maybe some of the interest really is starting to migrate to the application of AI.
Absolutely. It is starting to move to the application of AI, but I also think even within that, there are going to be winners and losers, right? So we're, in our outlook, we talked a little bit about just pure software exposure with something like an IGV, which is our iShares ticker, but also broadly, we talked about the need for being very active and nimble around it, because some of the names that are working now within software may just not work in the next 2 or 3 months. So really focusing on actively managing your AI and tech exposure, which we think is a much smaller component of our clients' portfolios than they think it is. So really focusing on things like BlackRock Active Innovation and Tech Funds, which is, again, an active way to manage your AI exposure and your broader software and tech exposure.
I will note that we're going to talk a little bit later to Bruce Richards. He posted on LinkedIn last week that he expects more distress in software because, well, the reason it's interesting is because private credit and private equity have really piled in. Does it matter? I guess there's dispersion there.
There's
as well.
dispersion there.
Yes.
That's exactly the sentence that you had started us on. There is going to be dispersion, which is why you can have a theme in your portfolio, but if you're looking for the next 3 to 4 years, being active around that, being able to dynamically rotate between one theme to another, we think is important.
I want to talk about the economic environment a little bit, because we were talking about Microsoft and Disney layoffs a little bit earlier. We get jolts at the top of the 10 a.m. hour, and then it's the all-important employment report on Friday. It seems like there's some expectation that we're going to see a little bit of cooling in the labor market, at least as it comes through with this JOLTS data. What's your expectation there? We're starting to get those headlines again, but we haven't yet seen it in the data.
Right, so we haven't. The one thing that I think the market paid a little bit of attention to is just the pickup last week in the initial jobless claims. Obviously, this week's JOLTS, which we've seen, again, we've seen a cooling, but I would say that cooling in all forms of labor market data is much needed right now. So we've seen a cooling in the job openings rate. I think we might see a further cooling in the non-farm payroll number that comes out on Friday. What might that look like? Could it be somewhere between 130, 140? That's lower than the 3-month and the 6-month averages, but still a very solid pace of job growth from at this stage of maturity for the U.S. economy. What I will particularly, look, it's a mature
Matt's
economy.
getting nervous.
This is like
this is an economy that's growing at 1%.
Right? But, Torsten Slok sent out a message today. Okay, 120, I guess, 130 for now, 120 for June. We're talking consensus here. 64 for September, 66 for December.
It's not very many thousands.
That much cooling would not be good,
That much cooling would not be good. So obviously, if tomorrow or Friday's number was significantly, and by significantly I mean 50 to 75,000 lower than expectations, and it was dispersed across many categories, across goods, and most importantly, across the services sector, which is where much of the job growth has come from. If we saw that, I think the market will certainly, the front end of the fixed income market will certainly price in some action from the Fed. But as of right now, that is not the expectation. I think there is going to be cooling. We should get used to that. There's another, there's obviously a lot of immigration outflows or based on how much immigration has been a driver of job growth in the last year. We have to take into account that that is not going to be the case. So again, other reasons for softening there. I think the market knows a lot of that. But obviously, there is a point at which it's a bad softening, not just a cooling, but something that makes us all afraid.
Makes me uncomfortable.
I don't think we're quite there yet. I think we're still looking at a U.S. economy, at least at this point, where the labor market is one of the shining spots.
Well, Matt is sweating over here, so let's try to get him a little bit more scared. I want to game plan that scenario the next few months where maybe, okay, you get a cooling down that turns into a softening in the labor market. Let's say inflation does have a little bit of pressure under it and it reignites a little bit. We had a note from JP Morgan yesterday, actually, writing that they think that we could enter into a stagflationary episode here that would end the S&P 500's rebound. Can you rule that out, or do you have to keep stagflation risk on the table?
I think you have to. I think the direction of travel could be in a stagflationary direction. Obviously, a lot of that depends on the growth expectations from the tax bill, as well as how much of the tariff unwind really, catapults many companies to go back to spending and manufacturing and all of that. So we are going to learn more about it, but this is why we talk a lot about adding diversifiers in your portfolio. So to the extent that many portfolios that we analyze have had a very high percentage allocation to U.S. equities, we're telling investors, close your underweight to the other areas of the world, close your underweight to emerging markets as well as European equities. You don't have to go overweight here, but certainly sort of have a more diversified portfolio. Add things like tips, add things like gold. These are areas of the market that we think could do well in that stagflationary environment. And very importantly, market neutral strategies that have a low beta and a low correlation to the broader S&P or the NASDAQ or the Dow that I know you love to watch. I think that's going to be another source of diversification much needed when uncertainty is high.
All right, Gargi, that's a good place to leave it. Great to see you again. That is BlackRock's Gargi Chowdhury. Meanwhile, let's get a check on this market and take a look at the setup, because we're taking a look at breadth again. And similar to yesterday, it's not awesome right now. It's not quite as bad as yesterday when we had more than 400 names in the red, but you can see we have more than 300 in the red right now, 176 pushing to the upside. Once again, it's NVIDIA that is leading the charge. Small move overall, but when you're that big of a company, that makes you the biggest gainer on a points basis here. You also have Broadcom, Tesla, and Constellation Energy higher right now. Take a look at the downside, though. This sticks out to me. Keep an eye on Alphabet, because once again, this is your biggest loser right now. If this holds, this will be Alphabet's 5th straight day of losses, down another 2% right now. Let's take a look at how this looks on the sector basis as well. It's close to an even split. I'm not quite sure if this is quite it, because I believe that I had tech at the top right now, but you can see we're talking about small moves overall. Utilities up top right now, up about 0.5%, industrials, and then tech. It looks a little defensive to me, Matt Miller. And then you take a look at the bottom, it's real estate, materials, and communication services leading the way lower right now, Matt.
Yeah, no, it does look defensive, but I think that's because of Constellation, right? So usually if investors are buying utilities, that's a sign that they may be a little bit scared. But today you've got Constellation up on the Facebook headlines. I want to also point out that if you're watching the breakdown of the Dutch government, the Prime Minister has offered to resign and continue in a caretaker government. Of course, that government fell apart because the coalition came unglued. When we come back, we're going to talk about something maybe a little closer to your heart, and that is Texas and the stock exchange in the Lone Star State. Texas is preparing for its stock exchange debut in 2026. We're going to speak with former Congressman Jeb Hensarling, who is now strategic advisor for the TSE. Next, this is Open Interest.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%. And I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans Remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
This is Bloomberg Open Interest. Quick check on stocks, and we are looking at gains right now, just barely, obviously, so I guess little change is a better way to put it, but they're not losses on the S&P 500 at 59.38. That's the cash trade. We're looking at a little bit better NASDAQ 100 trade right now, up 0.1%. You can see that the VIX is also unchanged right now, trading at 18.4, and Russell gaining about a third. In terms of the individual movers, NVIDIA once again pulling us up on the day, gaining more than 1%, which it's a $3.5 trillion stock. So that means a lot to the indexes on which it is listed. Tesla also a gainer today. You can see Facebook down after that deal with Constellation, but only about 0.4%, and Constellation itself gaining almost 7% on that new power delivery contract. Katie?
We'll continue to follow that story, but let's turn our attention to Texas. The Texas Stock Exchange has filed its Form 1 registration with the SEC to register as a national securities exchange. Reporting says it has secured over $161 million in funding as it aims for a 2026 launch. Joining us now, I'm thrilled to say we have Jeb Henserling. He is the Texas Stock Exchange Strategic Advisor and former chairman of the House Financial Services Committee, as well as Julie Fine, our own bureau chief down in Texas. And Julie, a great time for this conversation because I know Jeb, sitting next to you, has some big plans.
There are some big plans. You do have a pretty aggressive timeline, Congressman. Thanks so much for being with us. Sure. Are you still expecting the SEC approval coming later this year and the trading to begin in March or in next year, 2026?
Well, first, Julie, thanks for having me. This is the most exciting project I've been involved in since I left the United States Congress. And yes, to be part of the first fully integrated stock exchange to come to America in 2 generations. Very exciting. Worked with the SEC for a long time. We believe we're on track to receive approval for our Form 1, Q3, possibly Q4, and then trading to start in the new year. And we are very excited. It's going to help put Texas even more on the map than we already are.
Since this has happened, as you know, there have been a lot of other exchanges that have made some moves. The New York Stock Exchange has now placed an equities exchange here. NASDAQ has a regional office here. So, Congressman, how do you handle this competition that came from that?
Well, imitation's always the greatest form of flattery. I'm not sure had the Texas Stock Exchange been formed, you would have seen this action. With respect to the New York Stock Exchange, number one, we welcome the competition. And unfortunately, we can't quite compete yet until we get our Form 1 approved by the SEC. But, you know, with respect to New York, they took a Chicago medallion and Federal Expressed it here to Dallas. Again, happy to have them. NASDAQ clearly has an office, but we welcome the competition. We welcome the attention. And it really, in many respects, I think, validates one of our value propositions, and that is Texas is the place in America where people want to go to do business. And it's been the vision of Governor Abbott to make sure that not only is Texas the best venue to start a business, but to headquarter a business and now to incorporate a business and go public, trade, issue, all in Texas. And the Texas Stock Exchange is the next iteration to that. And we're going to have a lot of competitive advantages. But again, bring on the competition. It's a big state. Come on in.
All right. I love the ambition there. Let's talk about how you plan to compete, because one of the notions that's been raised is that maybe you need a few big anchor listings to really get the exchange off the ground once you list. And with that in mind, are you courting any companies at this moment to basically switch their listings when you do go live?
Oh, I think there'll be lots of companies that will will engage in dual listings. But Texi's going to be able to compete on a number of different fronts. Number one, we look very carefully at the economics. And we have a duopoly. I mean, that's just the fact of the matter. And because of that, we believe that there are efficiencies to be gained that can be shared with issuers. Next, Texi is going to be the issuer-aligned exchange. This is going to be a value-add proposition. Number three, there is going to be an advantage to list with a stock exchange that is actually based in Texas because of frankly, the political risk. Increasingly, companies have to calculate political risk. Texas has just passed 4 really major landmark pieces of legislation, one of which has to do with the fact that we're going to have written into our Constitution there won't be a financial transactions tax. They're threatening yet again to impose another one in New York. Technically, they have one. As you probably know, it's rebated. As a practical matter, they don't. In addition, on certain shareholder proxy fights, there's a very low threshold there. It takes up a lot of expense, a lot of C-suite time. There'll be a larger threshold, higher threshold in Texas. There's just going to be a lot of different reasons for people to come and enlist on the Texas Stock Exchange. And our CEO, Jim Lee, has put together the A-team. There has been a brain drain from the competitors, and already, as you may know, Dallas has more financial professionals today than New York. So again, we're going to have lots of competitive advantages, and as soon as the ink's dry on the Form 1, we're going to be happy to start competing.
Well, to your point, Congressman, I actually covered Rob Morocco and Allison Hennessy from NASDAQ and from SIVO coming over and joining with the Texas Stock Exchange, so that brain drain does seem to be happening. But I want to go back to the idea of switching listings, because one person and one company that has embraced Texas in a big way, of course, is Elon Musk. You have Tesla now incorporated in Texas. Have you been in any conversation with the team over there about potentially embracing the Texas Stock Exchange as well?
Well, I would say people at Texas are having lots of conversations. It's a little premature to talk about those conversations until, once again, the Form 1 by the SEC is approved so that trading can actually begin. We're very, very confident. Again, there will be major companies in America who are going to choose to list and certainly trade on the Texas Stock Exchange, and there'll be co-listings as well. But you're already starting to see, again, corporations, one, move from Delaware. You've already seen a number of companies that will change their listings. Already you have so much of the trading that doesn't even take place on the listed exchange. There's lots of opportunities to compete, and again, there will be a lot of competitive advantages that we believe Texi will have.
Congressman, you just talked about CEO Jim Lee, and when we spoke to him earlier, he said he now believes with this legislative package that Texas is in direct competition with New York and Delaware. So I want to know, before we let you go, what defines success for you in the first year?
We have so far met all of our milestones so far. So I think simply being able to establish a world-class trading venue come in Q1 of the next year, that we start to have large large Fortune 500 companies start to decide this is where we want to trade, and later in the year to be able to get new IPOs. And that's one of the whole reasons to start the Texas Stock Exchange. When I was in Congress, I cared deeply about the fact that we've seen this secular decline, if you will, in companies going public. I think Texas can help reverse that trend. So if you'll see that line start to flatten out, and again, we have more companies being able to go to the public markets and do it under the Texas brand, that will be success.
I really appreciate your time today. That is Jeb Henserling of the Texas Stock Exchange and our own Julie Fine, our Texas Bureau Chief. A great conversation about an ambitious upstart when it comes to the exchange place. Let's take a look.
Wait, did you say Y'all Street at all the whole time?
I didn't say Y'all Street, no, but thank goodness you did.
Yeah, because I love that.
Yeah.
Apparently they're calling it Y'all Street. So if someone says y'all to me in, you know, casual conversation, I feel a little sick to my stomach. But if you say Y'all Street, I think that makes it cool.
And it makes sense because it rhymes with Wall Street. It's very cute. Stocks turned green, by the way, during that conversation, the S&P 500.
Yeah, not because of that conversation.
No, but it did happen.
And this is a pattern that we've seen lately. I think Dan Curtis was saying this morning 19 times in the last 100
That sounds like something he would say.
sessions. All right, Gen Z says online dating is cringe, and Wall Street is taking note. Top Calls is next. This is Open Interest.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
All right, well, Bumble is getting downgraded to a sell over at JP Morgan. The firm expects revenue to decline as Gen Z moves away from dating apps, calling them cringe. More bad news for Bumble. Now, I was just checking, the stock is down nearly 90% over the past 5 years.
I know, because my wife bought $100 worth of shares. She believed in the women reaching out
It
model.
makes sense.
And she lost almost all of that money. Coming up in the next hour, billionaire Cliff Asness tells us how his firm is up more than 10% so far this year in a really volatile market.
First time, got to many times go visit with Steve Jobs to try to get an Apple box to be our box. And we were trying to merge boxes. And of course, they have Apple TV, we have our box. Never actually happened. And in one of the meetings, he said, well, you should give up because we're going to win that. But you should put Wi-Fi in all your boxes. And that's how you'll win. And you should be the best pipe. And he said the best dumb pipe. So I went home, went to our chief technology officer and said, what's Wi-Fi? And today we have the nation's biggest Wi-Fi network. And we have more customers. And 90% of your cell phone usage, 90% is Wi-Fi. Right. And that's because 70% of all the bits going over the internet right now are streaming. And streaming wasn't here 10 years ago. So I sit here and say the most exciting thing about our company is what's coming in the next 10 years that happens in innovation around the world, hopefully here in America, hopefully Silicon Valley, in LA and everywhere else, Philadelphia, and that we're going to continue to have bits per home go up.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. A third day of deadly violence for hungry Palestinians rushing to pick up desperately needed food in Gaza. Local officials say 27 people were killed in Israeli strikes on a checkpoint in Rafah. The BBC's Barbara Platt-Usher.
The shootings took place in roughly the same location as the deadly incident 2 days ago, less than a mile from an aid distribution site where thousands of hungry people gathered, waiting to be granted access. One eyewitness said the soldiers started firing heavily when people ignored warning shots and rushed towards the aid hub. The army said it did fire, but only at a few suspects who deviated from the designated route.
The Israeli military says it is looking into reports of casualties. Israel's foreign ministry says comments by the UN Secretary General referring to the violence as appalling are a disgrace. Smoke blowing into the U.S. from giant wildfires in Canada is spreading out. CBS News meteorologist Rob Marciano.
We're getting a little bit of rain in the area. That will help. So we'll look for some improving conditions, but smoke is going to head into the east as well. So everyone's going to see a little bit of this. Most of it will stay at the higher levels.
Millions of Americans are under air quality alerts. Harvard is warning of big losses if federal funding isn't restored.
In a new court filing, the university says the Trump administration's funding freeze will lead to the loss of data collection in health and environmental research, wasting public investment. It says labs will shutter, sensitive equipment will degrade, perishable samples will spoil, and researchers will go elsewhere. In another filing, Harvard says it has taken steps to address anti-Semitism and protect Jewish students, which the administration had accused it of not doing. Michael Wallace, CBS News.
In South Korea, supporters of the liberal presidential candidate cheering with an exit poll projecting Lee Jae-myung the winner over conservative Kim Moon-soo. The BBC's Jean McKenzie is in Seoul.
The new president now has to deal with pressing problems abroad. At the top of that list is high-stakes negotiations with President Trump over tariffs and South Korea's defense.
The winner will replace former President Yoon Suk-yeol, who was removed from office after he declared martial law. A new search is underway in the case of Madeleine McCann, the 3-year-old British girl who disappeared in Portugal more than 18 years ago. CBS's Lee Kinnery says they're scouring the property of a German man named Christian Bruckner.
Police haven't disclosed any evidence or details that explains why they've renewed this search nearly 2 decades on. But we do know they're focusing on land around the house of the only suspect.
The Dow is down 78 points in early trading. NASDAQ up 63. This is CBS News. There's a new report on the dangers of denying health care to trans kids.
Human Rights Watch says in the last 4 years, 25 states have enacted sweeping bans targeting gender-affirming care for trans youth. They say bans can lead to increased anxiety, depression, and suicide attempts.
These are people who grew up in one body and are at risk of, having that care in that body essentially taken away from them because of these laws.
Yasmin Smollins with Human Rights Watch.
These laws are what we call sweeping bans on gender-affirming care. So, that's any form of puberty blockers, hormone therapies, and they are estimated to impact over 100,000 trans youth.
Matt Piper, CBS News.
Fans fell in love with her character on The White Lotus Season 3.
Piper, no!
At last night's Gotham Awards, 56-year-old Parker Posey gave all the credit to the show's director.
Thank you, Mike White, for writing this character for me, for believing in a middle-aged woman.
Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
Are people just too exuberant out there?
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, good Tuesday morning we're at the BNY Mellon Insight Conference in National Shore Harbor in Maryland, right across the Potomac River from Washington, D.C. So we're here at the BNY Insight 2025 conference here at the Gaylord Resort here in National Harbor. It's a great resort here. We're going to have a lot of the really smart guests that are at this conference. We're going to be speaking to them over the next couple hours, so that'll be a good and wonderful thing. We're going to kick off with Ira Jersey. We had some economic data came in a little bit weaker than expected across the board. We'll talk to Ira Jersey about that. Kind of a mixed bag there. Jose Minaya, Global Head of BNY Investments and Wealth, on the macroeconomic outlook and how they are viewing these markets here. Also, Adam Voss, he's Global Head of Markets at BNY, talking about the flows that they are seeing on their platforms. So we got a lot of good guests down here in National Harbor, Maryland. Again, right across the Potomac from the District of Columbia. Right now, let's kick this thing off and go to John Tucker and a Bloomberg Business Flash. John.
All right, guys, this Bloomberg Business Flash being brought to you by IBKR Financial Advisors. Switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your answers. Learn more at ibkr.com/RIA. Paul, you mentioned the economic data. Let's get right to that. Job openings increased for the month of April. Remember, this survey goes back 2 months. This according to the Bureau of Labor Statistics. So all in all, there is one available job for each unemployed job seeker, according to this survey. The job openings rate rising 4.4% in April from 4.3% the previous month. So there are 7.391 million positions available out there. Also, we got numbers on factory orders fell 3.7% for the month of April versus the estimate of negative 3.2%. That comes from the Census Bureau. As a result, we have equities right now. The major stock average is little change. S&P 500, 59.35, literally unchanged right now. The Dow Jones Industrial Average, 84 points lower. That's down 0.2%. The Nasdaq 100 right now up 60 points. That's a rise of 0.3%. Dollar General, best performing stock in the S&P 500. Isabel's going to have a little more on that in just a second. That is followed by Constellation Energy. It is climbing after announcing a 20-year deal with Facebook parent Meta Platforms to provide it with nuclear power from its Illinois plant to run artificial intelligence and the data farms. 492 companies in the S&P 500. They have reported so far this season 78% delivering positive earnings surprises. And we check the markets for you all day long right here on Bloomberg Radio. We are brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. I'm John Tucker, Alex, and Paul.
All right, JT, great to see you. Sorry you're not here. It is beautiful. And, man, this Ferris wheel outside is ginormous. The Gaylord hotels are definitely known for that. I want to take a look at some of the stocks on the move today. I'm Alex Seal alongside Paul Sweeney. We're joined now by Bloomberg's Isabel Lee. Let's give me the latest here on Bumble. What's going on here?
So Bumble shares are lower by almost 8%. They fell after JP Morgan downgraded the stock to underweight from neutral. We have analyst Corey Carpenter saying that, yes, the shares may have rallied over 50% since President Donald Trump's Liberation Day, but still, he's just struggling to justify raising the price target given expectation for revenue and payer declines continue to accelerate. So he also added that online dating category remains challenged and that the Gen Z product or market fit has some issues. So maybe we're seeing a different shift in that space now. The price target is set to $5, which implies a roughly 13% decrease from the previous close.
All right, how about Dollar General? What's happening there?
This one is more exciting. Shares are popping around 15%. So this is the highest since August 2024 and the most since at least 2009. If my SINS is correct, that's a terminal function, SINS. So Dollar General, the ticker is DG, increased its annual guidance after the first quarter top projection. So it also said that it expects to mitigate a significant amount of tariffs that are currently in place. So the company sees same-store sales gaining as much as 2.5%. That's higher from their guidance in March. And they also nudged up expectations for EPS. So as we know, Dollar General's low-income shoppers have really been squeezed by inflation. We have the CEO warning earlier in the year that they are even skimping on necessities. And also the company has a lot of exposure from imports to China. But for today, it's good news. We have the shares higher by 16%.
I wonder if it's also like less bad than we thought based on all the things that you just said, Isabel, at the end of the day. All right, let's go to Pinterest. So I'm like cyclically obsessed with Pinterest.
Really?
Yeah, there'll be times where I'm like in it and I can't leave it forever. And other times I just totally forget all about it. But that's not getting an upgrade today.
Getting an upgrade, and I was all over Pinterest when I was in high school and college. Now I haven't checked it, Alex. So maybe I should have visited after this. But we have the shares rising 4%. JP Morgan raised the rating to overweight from neutral. We have analyst Doug Anmuth saying that a diversification of its ad platform is supporting further revenue. And Pinterest is also driving solid user growth with 85% of its monthly active users coming directly to the mobile app. Maybe this is why, because I use it on desktop still, so maybe I should download that mobile app. We have the analysts saying that valuation multiples based on 2-year forward EBITDA are appearing cheap. So they raised Pinterest price target to $40 from $35.
What? You use it on your desktop? You're not in high school anymore, Isabel. That's just bananas. All right. Thanks so much, Bloomberg's Isabel Lee. For more conversations just like this, subscribe to our new Stock Movers app reports. Listen for 5-minute audio reports. The biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere else that you listen. And Paul was pointing out earlier that we got some of that economic data. Factory orders lower for April. You also had job openings coming in better than expected. The quits rate also slightly better, although we are seeing more people getting fired or laid off. So I want to take that into account with Ira Jersey, Bloomberg Intelligence senior U.S. interest rate strategist. You're seeing a little bit of selling on that front end. Hey, Ira, what's your take on these numbers?
I disagree with that take, actually. The way that I look at quits being down a little bit and then layoffs being up a little bit is actually weak for the economy, because if you're not thinking you can find another job, that's the reason you don't quit your job, because you need to stay where you are. And then obviously with layoffs up, that's not particularly positive either. But it's all very incremental. These aren't huge moves, and certainly job openings being up a little bit in April, still not back to February levels. So again, we're talking about maybe lower highs here in terms of the downtrend. But some of the other data is also important to look at. So you think about factory orders, those missed to the downside, plus they were revised down as well the prior month. So overall, this is a little bit of a weak economy, and the front end selling off, so 2-year yields being a little bit higher here, is a little bit surprising, because yes, the data isn't terrible, but it's also not particularly good either.
Kind of, no matter how you slice it, Ira, it seems like this Federal Reserve is not really getting any clear signals what to do next, which I guess for a lot of folks means let's do nothing here. How do you think they're going to interpret today's data?
Yeah, well, I think that they're going to not be pleased with today's data, but at the same time, they're waiting for the next shoe to drop on inflation, right? So next week's inflation print is going to be important, as well as this Friday's payrolls report. But the likelihood that the Federal Reserve does anything at the June meeting is near zero, because you're waiting to see what the fallout is of all the tariffs. Will that increase prices? How will that affect inflation and the inflation outlook? So all of those things probably mean that they sit on their hands. In fact, the minutes last week, according to our natural language processing model, suggested that they were as neutral could be at the last meeting.
Yeah, he does this thing, and it's really cool. You put in Fed speak, and then his model tells them whether they're on the bullish or the bearish side, or I guess hawk or dove side, if we're putting it in Fed terms. So walk me through what you're expecting then for Friday and how we're positioned in the market, because honestly, it's been pretty calm the last 2 days.
Well, so one of the things that we've noted, and I was talking to our derivative strategist Tanvir Sandhu just this morning, and he noted that for long end, right? So we've had this lot of angst with what's going on in the 30-year debt and even 10-year debt, because of the fiscal situation and the fact that we're not really paying down deficits very much. That people are long puts, right? So people have gotten out of the money puts on long bonds. So therefore, it might be more difficult for the long end to sell off, just because people are appropriately hedged. But I do think that there's a lot of people who are kind of waiting and seeing what the economic outcome is going to be. But that being said, there are people who are nibbling at the edges, particularly when you get up to that 5% level in 30-year bonds, because liability-driven investors, so insurance companies, pension funds, and a few others, they're really interested in treasuries at 5%. So I think that's another reason why you keep on seeing a bid every time we kind of get above that 5% level on the long bond.
Long ago, Lisa Abramowitz taught me to look at the 210 spread there, and right now it's about 50 basis points of steepening. That feels kind of normal to me, or kind of reasonable to me. How does it look to you?
Yeah, so actually on a historical basis, it's actually still kind of low. Normally, when you look at the 2s-10s curve, it's somewhere closer to 100 basis points on average. We do think there's some structural reasons why I'm not sure that we'll get up to where it has during other cycles. But I do think that steepening is still probably the trade, whether it's bull steepening or bear steepening. We're more likely to see steepening than we are significant flattening, I think, over the next 6 months. The fiscal situation will likely keep the long end where it is, or maybe even actually have that cheapen, so yields going a little bit higher. But as the economy slows, which is our base case scenario over the course of this year, it will become more obvious that the Fed is going to cut rates, and cut rates maybe more aggressively than what's currently priced, and that will cause 2-year yields and the front end of the yield curve to rally and yields go lower. So that will steepen the yield curve. So we think that over the course of this year, one way or the other, whether it's bull or bear, we'll see more steepening of the yield curve.
Right, bull or bear, like do you get it on the front end and that's why the curve goes up, or do you get it on the back end and that's selling in the long end, and do we get that higher? Ira, thanks a lot. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, joining us there. And to that point, you're looking at the 2-year at 3.94 and that 10-year at 4.43, but it's the 30-year, Paul, that keeps getting all the attention. It's sort of butted up against that 5% level, but only closed above it like just a few weeks ago, but haven't been able to capture that level again and stay there. So
no. And it seems kind of, it just feels, you look at the curve every day like we do, it feels kind of range bound here. And again, probably waiting on the Fed to see what is the next move. Probably nothing in June, as Ira was suggesting, but maybe something later.
Yeah, which also brings up the question of correlations, right? And how do you manage that? Which brings us to where we are, and that is BNY Insight 2025, where we're going to break down how you position yourself within this market. Coming up, we're going to speak to Jose Minaya, a global head of BNY Investments and Wealth, on macroeconomic and market outlook. Plus, just
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, being brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. Equities, the major stock average is a little changed right now. The S&P 500, 7 points higher, up about 0.1%, 59.43 on the index. The Dow Jones Industrial Average is 18 points lower. NASDAQ 100, that's the outperformer in terms of the indexes. Right now, 84 points higher, and that's up about 0.4%. The S&P 500 kind of wavering. This came after the OECD earlier slashed the global forecast. You have 5 of the 11 major industry groups in the S&P 500. They are higher. Information technology, that's in the lead right now, and that, of course, is home to NVIDIA. Those shares are up 2.8%. Dollar General, best performing stock in the S&P 500. They increased the annual guidance after the first quarter topped analyst expectations. The discount chain also said it expects to mitigate a significant amount of the tariffs currently in place. That is followed closely by Constellation Energy. Those shares, they are climbing right now 3.6%. They signed a deal, announced a 20-year deal with Facebook parent Meta to provide it with nuclear power from its Illinois plant. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Now back to Alex and Paul at BNY Insight 25.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, we are live here at National Harbor, Maryland, BNY Insight 2025 conference. Great day here, a lot of good folks, and we're going to be speaking to them going forward. We've been waiting, Alex, for signs that maybe some of these trade uncertainties are going to start hitting real economic data. Today, the OECD, which is an international trade organization based in Paris, they slashed its government economic forecast due to Donald Trump's trade policies, citing the impact of tariffs and uncertainty on confidence and investments. Maybe we're starting to really see some impacts there globally. Zoe Chenet-Weiss joins us here, Western Europe Economy Team Leader. She's based in Frankfurt. Zoe, thanks so much for joining us here. Specifically, what is the OECD calling out for the U.S. and for the global economy?
So overall, the OECD, as you just mentioned, just cut its forecasts across the board. And like for the world, they were predicting for this year 3.1% growth. Now it's just 2.9. Similarly for the U.S., even more drastically actually, for the U.S. they were predicting 2.2, and now they just say 1.6. And they also next year for the U.S. just predict 1.5% growth. So overall, these are quite dramatic numbers. And throughout the whole report, the reason they give for this is Trump tariffs, and that this combative trade policy that's coming from the U.S. just is hurting the world all over, but the U.S. here in particular.
Mm-hmm. But Zoe, I wonder what their baseline is for tariffs. Is it at 10%? Are they taking into account the tariffs that are currently in place? Like, what's that tariff scenario?
The tariff scenario is just general uncertainty. So they are very aware that because of the constant change of Trump policy, that he says one tariff one day and then changes again the next, and then goes back and forth all the time, that there just is this inherent uncertainty here that will just hurt trade overall. If you look at the charts that say what trade would do, if you compare it with what they thought in December and what they're saying now, the picture is just incredibly dramatic. And they say that as long as this is there, as long as this uncertainty and this constant, what's it called, there and back again kind of trade policy is going on, that this is something that will just hurt the economy almost irrespective of what the tariffs are actually like then. Just that uncertainty damages so much.
Zoe, you're based in Frankfurt, and based upon my travel through Europe, I've always considered Frankfurt to obviously be the corporate hub of Germany and certainly much of Europe here. What are you hearing from the German executives that you speak to about what we're seeing over the last several months?
So Germany is in an interesting situation because we just had elections here in February, and there then a coalition was formed quite quickly, and even before the coalition was formed, because the fringe parties on the left and the right won so much in parliament, they still, in the lame duck parliament, still passed an incredibly generous fiscal package and also this huge defense package. So the defense package, we know it's tricky how this will trickle through with the economy, but the fiscal package is really massive, and also just generally gave our executives here in Germany a whole boost of confidence, because Germany, as we know, red tape here is everything takes ages. Red tape is very prevalent, and during the entire Scholz, the time that Scholz was chancellor, the economy barely grew. There was 1 quarter of contraction, 1 of growth. It just was really very, very sad. And so the fact that there would be this huge fiscal package made everyone happy. This was February. Then we got Liberation Day from the U.S., and that has made them more uncertain. Overall, though, given the uncertainty there, where this hurts investment, there hurts all that, but the fact that there is this huge fiscal commitment does make executives a lot more confident than they were.
All right, Zoe, thanks a lot. Really appreciate it. Zoe Schneeweiss, Bloomberg Western European Economy Team Leader. She just heads up all the stuff over there in Frankfurt. So she's in Frankfurt, and Paul and I are here in Maryland. We're right outside the National Harbor, where the BNY Insight 2025 conference is bringing together financial advisors to share ideas and leaderships and influencers, and to see how you manage your wealth in this very uncertain time. And here to help us understand that is Jose Minaya, Global Head of BNY Investments and Wealth. And he joins us now right here on set. Jose, thanks for joining us.
Thanks for having me.
Yeah, it's awesome.
Great energy over here.
Yeah, it's really great. We're really happy to be here. So we're talking a lot about the whippy headlines we have when it comes to tariffs, but your job is to talk to clients about wealth long-term and long-term investments. When they call you up in panic, what do you tell them?
Yeah, it's pretty interesting because there's more urgency and there is a little bit more anxiety in the voice of our clients. I would say our advice hasn't changed. Probably the last decade we've been talking about preparing yourself for volatility. You may have inflationary pressures, geopolitical uncertainty. What you see now, we are at a peak of uncertainty. And yes, the markets have kind of moved through this pretty well, yet our clients have felt the volatility. They've been through those moments where correlations went to 1, and what was a academic discussion around solutions and outcomes is now an urgency. So I think today what you're seeing is a lot of clients coming to the table saying, how do you help me protect my principal? How do you help me kind of drive towards income solutions? And what is the technology? What are the capabilities that we have to do that?
Has your portfolio construction allocation, has that changed any over the last 4, 5, 6 months, or is your equities, bonds, alternatives, that kind of thing, does that kind of stay the same?
That's always fluid, right? And as part of the investment process, I will tell you what has changed, though, is how we're delivering and executing to our clients. Again, you're seeing a lot more alternatives coming into the mix. You're seeing a lot more technology allowing that. I heard a stat this morning where fund launches, for the first time, there were more on the registered alternatives versus unregistered. This tells you that demand was there. Again, academically, people understood it, and now there's an urgency. So you're seeing a flow to how do we get more solutions-oriented versus a 60-40 portfolio or stock ideas.
But longer term, talking about correlations, there are questions as to that long-term treasury curve, right? And the sustainability of the debt and what that looks like, and then how it correlates to stocks. So in some ways, it's fluid, your allocation, but there could be a structural shift. What are you seeing?
There could be a structural shift. I think we're fortunate BNY clears almost the majority of the treasuries and markets. And it's interesting to me, I don't know what they're teaching at business schools today, but no longer could you just say, let's look at the yield curve and these things. Dynamics have changed. And today you're following what's happening with treasury markets, the liquidity in the treasury markets. But to the individual investor, it does not. Again, it goes back to what are your outcomes? How do we help our investors in that market and say, maybe you should protect more of your principal. Maybe there should be more of an income focus. What are the correlation benefits we're looking at? Yes, around the edges, you've got different investment processes, people that look at these markets. For us, though, is taking all the capabilities that we have, which run the full gamut, and saying, how do we deliver the right solution, customized for our individual clients?
Jose, we saw earlier this year funds flow out of the U.S. into other parts of the world, most notably Europe. Have you seen that on your platform, and is that still the case, or have they come back now that the markets have kind of stabilized here in the U.S.?
Yeah, I was wrong on that one at the beginning of the year. The U.S. exceptionalism, and obviously we came out into the start of the year with a lot of noise, tariffs, Liberation Day, these things, and so you have seen some of that. Then you've seen the market snap back as well. So it just tells you how uncertain this environment is, and in these environments, you also get asked the question: should we be risk off? Would that have paid off for someone to do? The idea is like, no, you want to be fully invested. Again, it goes back to what is the outcomes you're driving through that, and are you prepared for the fact that we're going to see uncertainty and volatility for the foreseeable future, probably through the rest of my career.
What are your questions from your clients different today than they were 10 years ago? Not necessarily in relation to the volatility that we're seeing, but just in terms of their goals, how long they're going to be working for, their retirement plans.
Good question. Absolutely. And again, I think it was this idea when I go back to academics versus urgency. We would try to bring the academic discussion to your goals and what you're doing. Yet you were in a market where you expected markets to just rise. We had almost 2 decades. So while those questions were always there, it was more of, am I getting the most? What's my total return? What's the alpha you're generating for me? Today, that conversation now comes right back to hey, do I have enough to retire?
Yeah.
Hey, I have these other life moments that I'm trying to prepare for. That was something that while the conversation was always there, it never made it really to the full-on, well, now let's build a portfolio for you based on these things, because the idea was we could just invest the money passively, index fund, it's all going to all tides are going to rise. That has changed. That there's a different urgency and a different conversation happening around people's wealth.
But we did see retail investor, they bought the dip. We saw that, the fund flows into equity ETFs was amazing, and they were right. Did you see something like that on your platform?
We did. And I was happy to see that. And again, it goes back to, I think there's strong stats on this. When you, through these times, you want to have advice. It's the people who have advice that you're seeing buying into this dip, right? It's that moment of, oh my God, I always say, what keeps me up at night? It's that we blink and we think the world's really changed forever. So you see these things, this idea of like not panicking, but kind of sticking to your fundamentals. And those folks who have bought the dip, it's played out well. Now again, how did they buy that dip? Are they diversified? How are they thinking about the markets going forward? That's a key, but it's good to see money coming back into the system after these dips.
Yeah. And then, exactly.
Funny, David, retailers were the smart money. It was great to see.
How many times have we said that?
We said that a lot.
They're getting good advice.
They're getting good advice. Very good. Jose, thanks so much for joining us. Really appreciate it. Jose Minaya, he is Global Head of BNY Investments and Wealth. Get his thoughts on the market. Coming up, Adam Voss, Global Head of Markets at BNY on iFlow. Hard and soft economic data and ongoing uncertainty of the market again. How is that being expressed here at the BNY Insight 2025 conference here? We'll get the latest there. So we have a busy morning coming up. The markets are mixed. We had some economic data out there, a little bit weaker on the margin. How's that going to impact markets and this Federal Reserve? We got some smart voices coming up here from the National Shore in Maryland. Well, more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major stock averages right now pull it a little change to higher. The S&P 500 10 points higher. That's up 0.2%. The S&P 500 10 points higher. That's up 0.2%. Right now, 59.46 on the index. The Dow Jones Industrial Average up just 10 points, and the Nasdaq 100 79 points higher. That is up just about 0.4%. Dollar General surging. They're increasing the annual guidance. This follows a first quarter that topped projections. The company does see same-store sales gaining as much as 2.5% this entire fiscal year. Right now, this is the best-performing stock in the S&P 500. Dollar General shares are up 13% currently. Energy, the best-performing major industry group in the S&P 500, as we see crude oil prices rising. NYMEX crude, that is up 1.8%, $63 a barrel. Job openings increasing for the month of April, defying Wall Street forecasts. The number of openings nationwide rising to 7.4 million in a pretty broad advance. And, of course, on the data front on Friday, that's the big one. The government issues the monthly employment data. The economist is forecasting a moderating pace of payroll growth. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that, Alex and Paul, is your Bloomberg Business Flash.
All right, JT, thank you so much. We appreciate that. Alex Steele, Paul Sweeney. We are live at the BNY Insight Conference 2025, National Shore in Maryland. I didn't even know this place existed, the National Shore, but it's very cool, right on the Potomac, right across the river from D.C., a great area at the Gaylord Resort here. One of the uncertainties for, I think, the markets in general is just kind of the disparity, or maybe not the agreement of hard data, some of this backward-looking data that the Fed looks at in terms of growth and inflation, maybe some of the forward-looking data like the UMich sentiment surveys, and maybe even the OECD forecast that came out today that shows softer growth. What do you make of it? I don't know. I'm going to put it to our next guest, Adam Voss, Global Head of Markets at BNY. He joins us on site here by way of New Zealand. Go figure that. Adam, how do you guys, in your markets outlook, kind of balance the hard data that's still kind of hanging in there and some of the softer data, the more forward-looking data that maybe ringing some alarm bells?
Yeah. So I think the short answer is time. Time will tell. But what do I mean by that? As I'm sure you talk about here with a lot of guests, this is the widest split between the hard and the soft data we've seen for some time. And so the way that we're thinking about it is, time will really determine if this consumer and business sentiment is going to anchor and pull down GDP growth and the underlying economy, or whether actually the resilience, because the data's okay. I'm sure you talk about that all day long. The data's okay. If that continues, then maybe what it's showing is the economy is resilient and can find its way through all of this uncertainty, and we'll see the soft data retrace it back up. So we're observing the same thing everyone else is, but I really think about it from a time factor. It can't stay like this forever. We've been like this for a while. We've started to see the soft data turn just a little bit. So the next few months are going to be key.
So that's sort of the consumer sentiment. What about investor sentiment?
Yeah. It hasn't really, from our perspective, from the clients I meet, and you had Jose on here before, there's definitely this uncertainty, and you can unpack that in a lot of different ways, but it hasn't really changed all that much.
Right, it's like anxiety, but they're not like putting their money where that mouth is.
Correct. So let me explain that through the data that we have. So we have this view called iFlow into what's going on across our client base. So what that's been telling us is some of the reducing of U.S. assets, some of the selling of U.S. assets has been there for some time. It's been there for a year or so. So often we'll get asked the question, is this a Liberation Day effect? Well, no, it's not, because some of the rebalancing we've seen has been going on for some time. So it's more gradual, medium term in nature, if you will. Where's it going? Well, we've seen some go into Europe over the turn of the year. You can see that in the asset prices since the turn of the year. But we've also more recently seen some of that go into the Asian markets in the last couple of weeks.
Did it surprise you that the retail investor was the one buying the dip here? And just if you look at fund flows into Qs and VUs and all the other stuff people look at on the ETF front, flows were coming in big time, even during the height of the uncertainty.
We saw the same. Does it surprise us? Well, if you look backwards, they've been doing it for quite a long time, and it's very much the investor sentiment. So we saw the same. We saw the institutional clients hold, largely speaking, so they didn't sell, they didn't buy on the way back up, but we saw that retail constituent and the wealth constituent buy the dip in April, ride it back up, and we're seeing just a little bit of rebalancing. I wouldn't quite call it selling, but we're seeing a little bit of exiting.
What about institutional? So they didn't buy that dip, they held. What are they doing now?
Outside of what we talked about, I would point out they're hedging the US dollars. So we have a way to see the hedge ratio of foreign investors for the US assets. And so, again, I'm sure you talk with a lot of guests about the outlook for the US dollar. It's been weakening where to from here. So if you put that through our data, there's more scope for clients to continue to hedge more of their international assets, their US assets from international investors, and therefore the weak dollar trend continues. So that's one thing that we see that's interesting, that's likely to continue.
You mentioned the weaker dollar. That stands in contrast to what we've seen for some other risk assets like equities, which have rebounded. The dollar has not. Does that suggest that maybe that era of U.S. economic exceptionalism, is that kind of a thing in the past?
I answer that in two ways. You have to take a step back and look at some of the structural pieces. There's many of the structural pieces of the U.S. economy that are still intact, that are likely to continue for quite a long time. The alternatives to those are nowhere near as strong. I also like to remember when these topics come up that it's very much about the starting point. And so we saw such a run-up in positioning and sentiment classified as U.S. exceptionalism that a retrace or a balancing or an unwind of that doesn't necessarily mean the story is over. But yes, we are seeing some exiting of U.S. assets. So I wouldn't go so far as to say that this is the end, but we do observe some of the same things that you're asking about.
And do you think that rebalancing or just a little bit of movement, is that permanent? Or does it come back? Or are we like permanently diversifying into, I don't know, what, yen, euro, European equities?
Nothing's permanent. This is why we're in the game.
Right, but meaning that, is it triggered by the current uncertainty, or was it an acknowledgement that, look, we're just really overweighted U.S. assets, we really just have to diversify?
I would say a little bit of both.
Okay.
As I said with the data, this isn't just a new administration trade policy exit. This is something that's been going on for some time. Mm-hmm. And so I think it's more moderate than that. But as we've seen, if you go all the way back in the data decades, things ebb and flow, and so we're in one of those ebb and flow cycles now, away from the US and into other asset classes. Could it turn around? I think it could. I mean, the question about the US equity market's a great one. It rebounds and catches people's attention, and it could easily attract assets back to the US.
You spent a lot of your career in the currency business. To you, what is the US dollar being the reserve currency? What does that mean to you, and is the dollar at risk of losing that level?
Let me answer it in reverse. I would take the essence of what I just said in terms of we're in a trend here, but the fundamentals are still strong. Okay. I would say the same thing about the US dollar. I don't think we're in a situation, as we sit here today, that the US dollar is going to lose its reserve status, but are people rebalancing away from the US from a very high proportion of holdings? Yes, they are. And so, like, what does it mean? In the currency markets, it's paramount, whether it's transactions, trade, funding markets, cross-currency funding activity. And so it's such an important part of how the market functions, and I think it will continue to be for quite some time.
All right, Adam, really appreciate it. Thank you so much, Adam Voss, joining us, Global Head of Markets over at BNY on the ground in Maryland here. Really interesting sort of diversification, and we think a lot about U.S. exceptionalism, Paul, and how it's, one or done, right?
Yep.
It's immediate rotation, but maybe it's not that black and white. Maybe there's some gray. Maybe you just need to diversify because you're just too levered at this point to, say, U.S. tech, for example.
Yep, so there's more ways to play it here, but we did see that move out of U.S. assets, broadly defined earlier this year. Some of it probably has come back during the market rebound, but maybe not so much in the dollar.
Yep. All right. Well, coming up, we're going to talk about one government that has failed, and that's the Dutch government, falling after the far-right party quit the coalition. We're going to break that down in just a moment with Dahasha Afanasieva joining us from London. This is Bloomberg. We are live from BNY Insight 2025.
Listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Tuesday, everybody. Alex Steele here alongside Paul Sweeney. We are broadcasting to you live from BNY Insight 2025 from National Harbor in Maryland with the Gaylord Convention Center. Huge. I put in so many steps despite
Yes.
not even trying to. We're kind of talking to a lot of advisors here about what the themes are within the market. We're also making sure to keep a close eye on all the news that's happening in the U.S. as well as overseas. And one headline that was pretty dramatic was that the Dutch coalition government fell after the far-right party quit that coalition. I feel like we've heard this song before. We're going to break that down for you now with Dasha Abasanieva, Amsterdam bureau chief, but she joins us now from London. Was this expected?
Well, it's expected because over the last week, Wilders has been threatening to exit the coalition if his demands if they don't back his 10-point plan to curb immigration. But the thing is, this has long been a fragile coalition, so you never really know if this is the time it's going to fall apart. So expected to a point, but maybe I didn't think it would come so soon.
Dasha, what are the key tripping points here to put together a government in Holland?
What are the key, sorry?
What are the key aspects keeping this coalition from staying in place here? What are the real challenging topics that need to be addressed?
Well, I think that the issue of immigration and how to curb immigration, have a robust legislative process to bring in laws that actually stop immigration but don't contradict with European law, are viable, feasible, don't contradict international law. This is the big challenge, that Wilders' party made all these grand promises about curbing immigration, and turns out it's really difficult. And he lost patience with the proper processes because his own party's migration minister was struggling to get her laws through Parliament, and instead went back to the drawing board and came up with these proposals. And some critics say that it was just a political maneuver because there were proposals that weren't going to be accepted, and that he was kind of looking for an excuse to collapse the coalition. Whereas he'd say that it was absolutely a necessity. What happens now is there's a process where the remaining cabinet members try to form a minority government. The likelihood, that's quite difficult to do, so the likelihood is that won't happen. There won't be a government formed, and then an election has to be called. The Prime Minister has already said that he's going to the King to resign and that he'll stay on as a caretaker, as part of the caretaker cabinet. So we're sort of waiting. The next big thing is to find out if indeed there will be an election and when it will be, because the longer the wait, the longer there's a caretaker government, and after that there's also a question mark whether there'll be a quick formation of government, because often a party doesn't get a majority, and all of the parties are way off from that, so they have to form another coalition. So there's sort of a lot of uncertainty, and all of that obviously delays big policy changes, dramatic transformative actions, and distracts lawmakers from the business of lawmaking.
Dasha, when I think of the Netherlands, I think of big port cities and big cargo ships serving all throughout Europe. What's the feeling within the Netherlands about kind of the global trade environment, and how changes might be happening with tariffs?
There's a lot said about how this is terrible timing in terms of the geopolitical tensions, in terms of trade tensions, and there's been a lot of many conversations amongst policymakers and in the papers about how we have to figure out new policies, because this is a different world, because the US has said that we have to pay more for our defense, because there are these trade tariffs. Everything's changed. So I think the Netherlands is very focused on that aspect and that uncertainty, and from that perspective, creating more domestic uncertainty over an issue that, yes, is very important to people. People are very upset about immigration, they're very upset about resources being stretched, very upset about the housing crisis, but it's not kind of as existential, if you will, in a macro sense. So there's a lot of distraction into these more like domestic political issues, and then how do you prepare, batten down the hatches, and work towards protecting yourself from the geopolitical sways.
All right, Dasha, we appreciate it. Thank you very much. Dasha Afanyandzeva, I'm going to get it one day, I swear. Amsterdam Bureau Chief joining us on the Dutch government and sort of what comes next after that government failed. One stock that I'm paying close attention to, I know it's a shocker. Yep. Can you guess it? You can't guess it. Constellation Energy.
Oh, okay.
It was up today. It's only up now at 1.5%. An agreement with Meta.
That is a cool story.
It is a cool story. And this is the second deal that Constellation's done in terms of, say, with Microsoft and Meta. We don't have any financial details on it, but how they structure it and what they do is actually really interesting, and it just keeps more nuclear power in the system for longer at the end of the day. All right, well, for our listeners in the U.S., here's a reminder. You can listen to us via satellite radio on Sirius XM, channel 121. Access the world's only global audio business network coast to coast 24 hours a day. Bloomberg Radio on Sirius XM, channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now with markets doing nothing. I feel like I have said this story before. I mean, the Nasdaq's up 0.6%, so maybe that's a little more than nothing. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
Are people just too exuberant out there?
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Happy Tuesday, everybody. Alex Steele here alongside Paul Sweeney. We're broadcasting to you live at BNY Insight 2025 at the Gaylord Convention Center in National Harbor, Maryland. Beautiful backdrop for really interesting conversations. We talked to financial advisors as they come together and talk about the investment themes and how to position in this time of uncertainty. A great hour lined up for you. Emily Portney is Global Head of Asset Servicing at BNY. She'll join us. Jim Crowley is a Global Head of BNY Pershing on the future of wealth management. I mean, wealth management is huge.
Yeah.
Like, that is the growth driver of any business right now.
Yeah, it is. And one of my offspring is in that business. And I just forwarded him a couple articles that I just read here about how he's in a great spot. Keep working at it.
Whereas like 20 years ago, private wealth would be like, yeah, whatever. But,
Exactly.
But this is the moment. And for Paul's son, he hopes and he agrees. So we're going to get you all set up. We're also going to talk about some of the market moves. Mandeep Singh will be joining us from Bloomberg Intelligence to break down what I'm looking at, and that's that deal of nuclear power between Constellation Energy as well as Meta. But let's kick it all off for you right now with a Bloomberg Business Flash. And for that, we go back to New York with Charlie Pellet.
All right, thank you very much, Alex. Still, here's what's going on. The Dow, the S&P, NASDAQ solidly in the green. Best level of the day right now on the S&P. Higher by 19 at 59.55. That is a gain of 0.3%. The Dow up 54, up 0.1%. NASDAQ higher by 133 points, up now by 0.7%. Our Mag 7 index up by 0.6%. Again, keeping it all in context, the S&P showing a gain right now of 0.3%. 10-year 4.43%. The 2-year 3.95%. Spot gold now down 1.1%, 33.45 the ounce. And West Texas Intermediate crude up 2%, 63.76 for a barrel of WTI. Traders are pushing stocks higher after data this morning showed the U.S. labor market is holding up, offsetting concern that equities have run too far too fast amid economic risks stemming from tariffs. Chris Harvey is head of equity strategy at Wells Fargo Securities. On Bloomberg Surveillance this morning, he told us he does see reasons to be optimistic.
We're looking at the data, and we're looking at 6 months ahead of time, right? We think we have seen maximum uncertainty. We think we have seen the bottom of the market, and we think that we're going to work better from here.
And you can hear more of the conversation with Chris Harvey on the Surveillance podcast. You can download it wherever you get your podcasts. Constellation Energy has agreed to sell power from an Illinois nuclear power plant to Meta Platforms as artificial intelligence sends power demand soaring. Constellation is the biggest U.S. nuclear operator. Its shares up today by 0.5%. Meta Platforms down 0.5%. Again, recapping the Dow, the S&P, and NASDAQ all advancing. S&P now higher by 0.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, live here at BNY Insight 2025 at the Gaylord Conference Center in National Shore, Maryland. Where is National Shore, Maryland, you might ask? Right across the Potomac River from Washington, D.C. Very, very cool area. So let's take a look at some of the stocks on the move today. I'm Paul Sweeney along with Alex Steele, and we're joined by Bloomberg's Red Brown. Red, what do you got?
Yeah, number one on my list right now is Dollar General, up around 12% intraday. That's actually their best move. 13% now. That's actually their best move since May of 2022, and this comes after the company trounced earning expectations and raised their full-year guidance as well. The earnings beat biggest outperformance since 2021. So, yeah, really strong results. Companies clearly doing well to mitigate some of the tariff impacts that they called. Out of this report is that they're seeing actually higher income consumers start to trade down to Dollar General. So quite a lot of kind of interesting details from Dollar General. Not one that we usually watch too closely, but a good one for today.
Also taking a look at Constellation Energy. That's one that I'm super interested in. Meta and Constellation Energy teaming up to expand nuclear power, continue nuclear power generation to help Meta out.
Yeah, no, I saw you mention that one just a little while ago and getting a bit more information later, but maybe a bit of a primer. The shares are kind of flat now. They were up 9% and pretty strong move for the company. Again, that's so kind of following up on some of the details you give there. It's a 20-year contract with Meta for over 1,100 megawatts of power, and that'll start in 2 years. We didn't get financial details, but I think just given some of those numbers and the length of the contract, I think this is quite a healthy deal for Constellation. And it really is yet another one of these kind of flashy announcements from AI and the knock-on effect of the AI investment that we keep getting. Last year, we saw 3 Mile Island will be restarting to support some of Microsoft's ambitions. So yeah, just another really interesting development in how AI continues to reshape a lot of parts of the economy.
A little I'll explain here for you.
Yes.
You ready? Okay.
Go.
So basically what winds up happening is this is the Microsoft deal, so we can extrapolate those terms. Microsoft pays Constellation. Constellation sends energy to the grid. Then Microsoft buys it from the grid. The difference then is made up between Microsoft and Constellation. So if Microsoft pays more, Constellation's to pay them back. If they pay less, Microsoft tops it off to Constellation.
Love
so
that.
it's not like a one-for-one. We don't know if those are the correct terms, but I have it on good authority. But we can kind of think it's something a little bit similar. Are you good? That was Alex.
I'm on it. I'm on it.
He was on it.
One more. How about Lululemon?
Yeah, Lululemon. 2 analysts upgraded their target prices this morning, and that's just ahead of earnings on Thursday. So kind of a positive signal for Lululemon. I mean, this could be a stock that a lot of people they have been down on Lululemon this year. I think it's down around 13%. But it has rebounded 30% since April lows, since we started to get maybe a little bit of the cooling in the tensions between some of our trade partners when it comes to tariffs. So, yeah, I think that's kind of a positive signal heading into earnings. Analysts are kind of calling for a beat at the top line and then reiterate for the full year targets. And right now in this market, that's kind of good enough for a lot of these retailers to get a positive stock reaction. So anything else? I mean, there's a couple of other things to keep an eye out for that earnings on Thursday is really keying in on U.S. trends, whether or not they appear stable for the rest of the year, whether or not people are maybe pulling forward some of their purchasing to avoid maybe higher costs. But right now, all things seem to be pointing in a positive direction for Lululemon. New colors, new products, continuing to push into men's categories, shoes, things like that, all resonating with U.S. consumers.
Apparently not tights, though, for you guys.
Thank goodness.
We were a little worried about that.
Yes.
No, JT would be checking that out.
Yep.
All right, Red, thanks very much. Red Brown joining us from Bloomberg. And for more conversations like this, subscribe to our new Stock Movers reports. Listen to 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere else that you listen. All right, I want to talk now about Fannie Mae and Freddie Mac and how, and potentially, the Trump administration may not now be willing to give up control.
What?
I can't keep track.
No,
It's like you talk about volatility and whipsaw. Just look at what's happening with Fannie and Freddie. Ben Elliott joins us now. He covers the consumer for us for Bloomberg Intelligence. He's a consumer finance analyst. Ben, what is happening?
There's a lot of confusion out there, right? The administration is kind of talking past itself, saying a couple different things. But the reality is these companies are contractually owed, or do contractually owe Treasury $350 billion. And essentially the optimism in the stock is that the government will just write that down. And if you know anything about the way the Trump administration works, they see the potential for a windfall. They're probably going to capitalize on it. So it feels as though the optimism was always a little misplaced, and now people are kind of coming around to realize that this could be more complicated than it seems.
Yeah, as a markets guy, Ben, my just natural inclination is let's get these things into the marketplace and let the market value them however they will value it. What's the counter argument there? Why haven't they been coming? Why haven't they been brought to market?
Well, it's just because of the huge overhang of Treasury's ownership stake. It's not as simply sort of structured as some of the other financial crisis investments were. There's something called a liquidation preference, which kind of is rising every quarter as the companies earn more money. So basically, the government needs to decide what they're going to do with that stake. A lot of this has been litigated for over a decade. The Supreme Court has basically decided that, the companies have not paid back the government. And so, no new money really wants to buy into a gigantic, multi-decade lawsuit with a $350 billion overhang. It's just impossible to say what the stock could be worth.
I just don't understand how the government can kind of sell its stake, but then also keep opinions. Like, I don't, or even an implicit guarantee if it's not an explicit guarantee. I mean, it feels like there's no gray in this, no?
Well, so there's a little bit of there's an existing backdrop, which has a number on it, which is $240 billion. That Treasury still agrees they'll pay to the enterprises if they have a shortfall in their earnings. So the idea is you could release them, maintain that backfall, and charge the companies a fee on an ongoing basis to earn money for Treasury. But the reality is $240 billion is not enough to cover, unexpected losses. So then the implicit guarantee is that, hey, it's not $240 billion, it's whatever they need.
All right, I guess we will kind of wait and see like everybody else, Ben. I'm just a lot of uncertainty out there, as you were mentioning before, about what the government ultimately wants to do with its stake in Fannie Mae and Freddie Mac. We'll stay on top of that. Ben Elliott, that's his job. Bloomberg Intelligence, consumer finance analyst. He's all over that stuff, so we'll stay on top of that story. Let's get back to the BNY Insight 2025 conference here in National Shore, Maryland. We're joined by Emily Portnoy, Global Head of Asset Servicing at BNY, on shaping the future of asset management. Emily, thanks so much for joining us here. Advisors, they've got fee pressures, they've got ever-changing marketplace they have to navigate. What do they look to you guys for today that's maybe different than in years past?
So it's great to be here. Thanks so much for having us. In terms of what I'm seeing and what we're seeing more broadly, BNY, across both asset managers and wealth managers, are several different themes. So certainly one is the rise, the ever-importance, increasing allocation to alternative investments, and that is becoming an ever more prominent and important part of asset allocation. Second, what I'd say is just the proliferation of wrappers and vehicles. So it used to be you had kind of just mutual funds, and they were pretty much the most prominent wrapper in the industry. Obviously ETFs, and now of course not just passive ETFs, but also active ETFs. We're also talking about ETFs in an ETF share class in a mutual fund. I mean, that's something that's we're getting a lot of questions around here. Thinking about the things like in the alternative space, whether it's interval funds, BDCs, tender offers, etc. So there's also this proliferation of wrappers, and so one of the questions we're getting here at Insight is, how do you help me launch and manage all of these different wrappers? And of course, that's something that BNY is very uniquely capable and able to do for
so
on behalf.
How do you do that? Because you're right, like you have a slew of stuff. They have to be able to explain it to their clients, and that's really tricky. So how do you help them?
So BNY, we actually can help our clients literally all the way from manufacturing, launching, and placing a product, and even knowing what kind of wrapper to put a strategy in, through to administering it, through to servicing it, and of course, we're here at Insight, it's all about Pershing, through to distribution on our shelf. So we can actually help you through the entire life cycle of launching a product.
I was thinking, Emily, you sound so smart. I wonder why that is. Duke University.
Oh,
boom, there you go. That explains a lot.
Blue Devil.
Exactly. Years ago when we first started coming to this conference, and I talked to a wealth manager and RIA about their allocations alternatives, I thought the response would have been like, 5%, 10%. Way higher than that, 20, 30%. I'm like, really? I mean, I understand that. I was just surprised that a kind of a registered investment advisor with individual wealth clients would maybe take that much risk, that much liquidity risk. What are the conversations you have with the wealth managers these days?
Well, I think I would almost say there's two strands there. There's your more institutional asset owners, which actually, and I travel the world and speak with many of them, and all of them are going from, if you had 2%, you're going to 5, you're going to 10. If you had 20%, you're going to 50%. It's just an ever-important increasing allocation, especially for large institutional asset owners. When you get more to the wealth space, it is growing considerably, but off a much, much smaller base. And that is ultimately, again, for diversification, for yield. And when you just think about, too, the amount of private companies, we had a stat early this morning that said that something like 80% of companies that make $100 million of revenue or more are now private. That is a whole area that really has to be open to more retail type of investors. And obviously there's a lot of conversations, and we can really help do that as we start to launch more registered funds that actually have the liquidity profile that is probably more suited to a retail type investor in the wealth space.
But isn't that counterintuitive though? Like, I want alternative investments, and you're taking on the liquidity risk because you're getting the returns. If you make them more liquid, doesn't that wind up negating the whole point?
Well, certainly an advisor has to be very educated in terms of understanding and balancing the risk associated with any type of investments and portfolio strategy that they're constructing on behalf of a client. But these new types of wrappers, interval funds, etc., actually do have the liquidity profile. They're registered vehicles, so they have a different liquidity profile than you would normally see in the private fund space that really was suited more towards institutional investors. And that's where a lot of the innovation is happening, because you are right, liquidity is a key concern, and that is actually the holy grail. How do you create strategies and the right wrapper that actually provides for the right liquidity profile for retail style investors?
ETFs have been one of the greatest, most amazing developments in financial services that I've seen in my career. How's it impacted your business?
Well, ETFs certainly they're one of the many products that are continuing to grow at pretty much double-digit pace. Whereas before, ETFs were very much more for passive investments. Now, actually, where all the growth is very much on the active front. And also what you're really seeing there is buffer strategies and other types of strategies where you're using derivatives overlays, etc., to actually customize those ETFs for different types of returns and different types of strategies that individual customers are looking for.
Amazing. All right, Emily, thanks a lot. We really appreciate it. Emily Portnoy is Global Head of Asset Servicing over at BNY. Just so fascinating on how the change is happening there. Much more coming up from this conference, but we're going to keep you updated on the news of the day. We're going to go to Mandeep Singh next, Bloomberg Intelligence Senior Tech Industry Analyst, about that deal between Meta and Constellation Energy, kind of what's
we're coming
behind
back to that.
Yeah, I did the energy side. Mandeep
I
Singh
see.
did the tech side. We're also going to talk to Michael McKee, Bloomberg International Economics and Policy Correspondent, on the data that we got out this morning, JOLTS, and those factory orders as well. So we got much more coming up for you from this amazing conference right here at the Gaylord National Convention Center in Maryland. Taking a look at the equity market, it's pretty calm. The NASDAQ is up just 0.6%. This is Bloomberg Intelligence. Happy Tuesday.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is the Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all advancing, not just higher, but best level of the day right now on the S&P 500 index, looking at a gain of 23, up by about 0.4%, 59.58 where that index stands. The Dow up 82 now, up 0.2%. NASDAQ up 145 for the NASDAQ Composite Index, we're up by about 0.8%. 10-year at 4.44%, the 2-year 3.95%. Gold now down 1%, 33.47 the ounce. West Texas Intermediate crude up 1.9%, 63.71 a barrel. And Bitcoin now at 106,700 on Bitcoin, up by 1.7%. This Bloomberg Business Flash brought to you by Oracle. Attention growing businesses. Oracle's offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. Victoria's Secret says a security incident that caused it to shut down its e-commerce site may hurt results for the current quarter. Victoria's Secret was expected to report earnings this week, but now says it's delaying the release of results because employees are unable to access some information. Shares of Victoria's Secret, right now they are up by 2%. Again, recapping, S&P best level of the morning, up now by 0.4%. And for on-demand news, 24 hours a day, subscribe to Bloomberg News now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thanks a lot. Really appreciate it. Alex Steele and Paul Sweeney here at BNY Insight 2025. We are in Maryland, right at the National Harbor at the Gaylord Convention Center, as we have a lot of financial advisors kind of coming together and discussing ideas and how to manage asset and wealth management for 3 days of learning experiences and networking solutions as well. Really been a fascinating time so far. Keeping an eye on some of the equity moves. One is Meta and Constellation. Constellation Energy is up a little over 0.5%. Meta's down by 0.5%, but Constellation Energy agreed to sell power from an Illinois nuclear plant to Meta Platforms. It's a 20-year contract starting in mid-2027. So Constellation is going to boost its own investment into the Clinton plant's output, and maybe will actually build another reactor at the site. I did the energy angle. Let's get the tech angle now with Mandeep Singh, Bloomberg Intelligence Senior Technology Analyst. Okay, Mandeep, why does Meta need this?
Well, if they're raising their capex, which they did in their last earnings, that capex is going towards, getting more AI chips. And, if you are putting more AI chips, you need more power. So clearly, that is where the shortage is right now. And look, if this is an AI supercycle that we all believe it is going to be the case, and I think you will see a power supercycle as well. And in this case, all the hyperscalers will be looking to procure power for their data centers. I mean, Meta serves over 3 billion monthly active users across their family of apps. Now, granted, those users right now are using more CPU compute, but if you're rolling out AI tools and LLM searches, you need more power for the AI chips, and I think that's the intent here.
Hey, Mandeep, let's be honest here. I mean, all you tech guys, you Silicon Valley guys, you always think you're the smartest guys in the room. But let's be honest, you guys don't know anything about the oil and gas business and the nuclear business. Why is Meta, and I'm guessing some others, are going to kind of get more deeply and strategically involved in the energy side of their business? Is this a trend here?
I mean, just look at how far they have come in terms of, infrastructure. Like a company like Google, not only are they designing their own data centers and, creating their own chips, and now they are, procuring power to the extent that they want to make sure that these AI chips, which can have volatile power needs, are most optimized when it comes to the efficiency of their infrastructure. And that's why these hyperscaler companies really have got so many different aspects to their moat. So it's not just about the search algorithm, or in the case of Meta, their social media knowledge graph. it is about the entirety of how they run their infrastructure, and that is what is a long-term mode, because nobody else can operate at the scale at which these hyperscalers are operating right now.
This is a fun fact in the article by Will Reid from Bloomberg. So Meta, first of all, has a global energy head.
They have a global energy head.
Yeah.
Okay, all right.
So they do. They're really kind of ramping that out. And they were looking at proposals. They announced in December they were looking at proposals for as much as 4 gigawatts of new U.S. reactors, and it received 50 proposals from a range of companies, including Constellation, to that point. I'm also wondering, Mandeep, the significance of when they're building data centers and hyperscalers for LLMs, a large language model, and that training versus when they have to build stuff for inference, which could be smaller and more co-located, so closer to the cities, closer to where Paul and I have our phone. Does that tend to look different then in terms of their power needs?
Absolutely, and I think so far the market was concentrated towards training. Every year you would have a 10 times larger model, which was more intelligent, and it could do more in terms of answering your queries. But with inferencing, you're right. I mean, the traffic patterns may vary depending on the population. And so if you're serving traffic in New York, it's very different from serving traffic somewhere else that may not have the same concentration. And with that, I think the challenge these companies have had is the transmission lines can be upgraded. I mean, you need, a pretty lengthy review process, and the whole thing may take years. So right now, they are trying to procure power wherever they can, to offset the increased consumption, and some of it may come at the expense of power usage for some other purpose than why data center is being prioritized here. And that is what will be interesting, because with inferencing, the power needs can be variable. I mean, one trend we have seen is with reasoning, you need more compute. So, the model is thinking a lot more at the time you are putting the prompt in, as opposed to training, where all of the training is happening in background over a period of few weeks. So reasoning is per query, and depending on how complex your query is, the model is doing more work, and that's why it may need more power.
Another data point from this Bloomberg News article: Meta is contracting for more power after the company's total electricity consumption nearly tripled from 2019 to 2023. So, yeah, I guess they need some more energy. Mandeep, is this in the CapEx numbers for Meta and for these other tech companies, or do they need to take those CapEx numbers up even more if they're going to get deeper into the energy space?
I mean, all signs are the CapEx numbers may continue to go up, but right now the biggest component of the CapEx is still the spend on the GPU chips. Obviously, the power needs will take some portion of the CapEx, but it's still not as big as the chips. And think of it this way: if you're getting, 20,000 NVIDIA chips, the cost of keeping them idle or not being able to utilize them 100% is way higher than anything you are spending in terms of, the energy deal that they had. So clearly they are focusing on utilizing the chips that they have already procured, and that's why they are proactive with, these power deals.
All right, Mandeep, thanks a lot. Really appreciate it. Mandeep Singh joining us, Bloomberg Intelligence Senior Technology Analyst. And also, power growth has been 1 to 3% tops for decades, and going to 7 is crazy. It doesn't sound like a big number for tech guys, but for power guys, it's nuts.
But I'm just observing what we've been talking about more and more and more this year has been nuclear power.
Well, because it's already there.
Okay.
You can just expand it, or instead of shutting it down, you keep it running, and it's something similar that we're seeing with coal versus picks and shovels in the ground. We're not building a new nuclear reactor yet.
Okay.
We haven't gotten to that point. We got some interesting data out. We got factory orders for April coming in a little bit light. We also got JOLTS. Want to get more on this with Michael McKee, Bloomberg International Economics and Policy Correspondent. Hey, Mike, what's my takeaway from these numbers this morning?
Not much. That we're kind of where we were and have been. There are more job openings, or there were in April. It's 2 months ago now than anticipated, which means it may be a little easier for people to get jobs if those are accurate numbers, which there's a lot of doubt about with the JOLTS numbers. So it doesn't really tell you what's going to happen going forward is the issue. Factory orders, we know that the businesses have cut back on spending, but it really hasn't shown up in a huge way yet, and that's just starting to make its way into the data. We're kind of at the last stand for the way we look at economic data. We're in the last weeks of the untariff tainted data, and it should start to show up soon. Now, so the question is going to be, how bad is it going to be?
Yeah, I mean, again, you helped us understand the JOLTS data before, so I guess the layoffs level higher, that's not good if I'm an employee. But the quits level is lower, which is if I've got a job, I'm not quitting and looking for something better. So put those two together, and it kind of suggests maybe a little bit of softness in the labor market.
Yeah, it does. It suggests that we are seeing more caution on both sides of the hiring equation. Companies are starting to let people go. We've seen some announcements of that in recent weeks that wouldn't even be captured in this. Disney yesterday, for example. And we're seeing the caution on the part of people who don't want to quit their jobs now because they're a little nervous about finding another one. The question with the job openings always is, are those real openings or are they multiple openings because companies are just trying to throw out ads to try to attract resumes without really planning to hire somebody? So there is some question about whether we should worry about a rise there or not.
Mike, how important do you think the jobs number will actually be on Friday? You said that we're just starting to get the last of the clean data, right? Are we going to have to wait until the July reading for June to really get deeper into the jobs number here?
Oh, I think so. If we get anything like the forecast 130,000, it'll tell the Fed that the economy is slowing down, but it won't suggest that the economy has started to seize up or anything like that. It's been part of a trend that the economy is creating fewer jobs. And actually what we've seen is in the last couple of months, numbers come in better than forecast. But it's the unemployment rate that the Fed is really going to pay attention to. And that's where the JOLTS numbers could figure in. I mean, again, they are 2 months behind, but the unemployment rate isn't going to go up as fast if, when people lose jobs, they can find other jobs. So it's kind of a puzzle to put it all together going forward. But I think you're right, Alex. We're not really going to have a definitive picture of the labor market until we get into July or August even.
Right. All right. Something to look forward to, I guess. Michael McKee, Bloomberg Economics guru, giving us the latest breakdown on some of the economic data we had today. Coming up, Jim Crowley, global head of BNY Pershing, on the future of wealth management. He's going to be on site here at the BNY Insight 2025 conference. We're here at the Gaylord Conference Center, National Shore, Maryland. Very cool place. I highly recommend. Right outside D.C. I'm heading into the district today to see some cool stuff. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ, all advancing. S&P right now trading at the best level of the morning. Traders pushing stocks higher after data showing the labor market is holding up, offsetting concern that equities have run too far, too fast. Right now, the S&P 500 index is up 26 at 59.62, a gain of 0.4%. The Dow up 140, up 0.3%. NASDAQ up 141, higher by 0.7%. Our Bloomberg Mag 7 index is now advancing 0.6%. The 10-year, 4.45%. The 2-year, 3.95%. Spot gold down 1%, 33.49 the ounce, while West Texas Intermediate crude, 63.70 a barrel, up now by 1.9%. This Bloomberg Business Flash is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor-to-staff ratio, small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about their consultative support and technology. Job openings increased in April, defying Wall Street forecasts. And with that story, here's Bloomberg's Vinny Del Giudice.
The number of job openings nationwide rose to 7.4 million in a broad advance. Professional and business services, as well as healthcare and social assistance, led April's gain. Businesses have been hesitant to cut jobs, but jobless claims have been running low, supporting the Federal Reserve's assertion that America's labor market is in a good place. On Friday, the government issues monthly employment data, and economists are forecasting a moderating pace of payroll growth. Vinny Del Giudice, Bloomberg Radio.
On a day when the S&P 500 index is up by 0.4%, Dollar General shares are now surging 12.4%. Dollar General slightly increased its annual guidance after the first quarter top projections. The discount chain also said it expects to mitigate a significant amount of the tariffs currently in place. Again, Dollar General right now up by 12.3%. And some of the other stories that we are following for you, Treasury Secretary Scott Bessent says China does have a choice on whether or not to be a reliable partner with the rest of the world, reiterating that it needs to be more of a consumption-led economy. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate that. Alex Steele, Paul Swinney, we are live at BNY Insight 2025. It is the National Harbor. Scott from Washington, D.C. writes in and corrected me, which I appreciate. It's not the National Shore, it's the National Harbor. It's a great spot right across the Potomac River from Washington, D.C., so we're happy to be here in this Gaylord Convention Center. Our next guest, Jim Crowley, Global Head of BNY Pershing. We talk to him every year. We come to this event, and he provided some really good notes on where the wealth management business is, really helpful notes about where the industry is and where it's going. I sent those notes, Jim, to my third offspring, who's in the business, major financial firm. And I said, don't get frustrated. Keep working hard. You're in a great spot. Keep learning. Talk to us about where the industry is, the wealth management business is today, because it seems like the next 20 to 30 years are going to be really important.
Well, let's just pick up on that point, Paul, because, this is a $90 trillion wealth industry in the U.S., and some estimates have 100,000 advisors aging out over the next number of years. What a great opportunity for the youth of America to sort of come into an industry that is so vibrant and does such great things for the community to help people secure sort of their financial lives. It's so important, and I find it to be quite rewarding. I've been doing it for a number of decades.
So what's the coolest thing that's happening right now in the industry that was like not on your radar 5 years ago?
Okay, so there's quite a few things, but let me talk about like the most coolest thing.
Okay, most coolest.
The most coolest thing is how we really have reimagined Insight, because I think this is our 26th, 27th year, something like doing this event. It started out as a research conference with like a dozen people around the table just talking about stocks and bonds. And here we are with over 2,000 people, and it's now BNY Insight, and we're delivering all of the solutions that BNY and the entire franchise has to be more for our clients and support them in ways that goes far beyond just sort of custody, which is kind of the classic business. So that's the most exciting thing, to have many of my colleagues here talking about the different sort of things that we do and platforms and products and solutions and services that we have at BNY to help them grow.
What I hear over the years, maybe increasingly so over the years, is advisors saying, I want to get away from the back office work, the kind of running the business. I want to be with my clients, talk to my clients, trying to help my clients. Technology, how does that play a role?
Yeah, so first of all, I think spending time with clients is obviously very, very important, right? We're talking or listening to Jesse Itzler talk about authentic relationships and how important it is. We talk about scaling with trusted partners at BNY. Technology is really evolving the business. I was talking about AI in the main stage and how we have our own AI hub called Eliza. Maybe you've heard of it. Mm-hmm. We have over 90% of our employees on Eliza now. 10,000 people have created their own agents. I've created my own agent. So it really is transforming the business. I created this agent to sort of evaluate how I'm doing against my goals and my objectives for the year. And Eliza gives me feedback.
Wow, that's amazing. But can it also make your day-to-day easier? And I guess, so for Paul's third offspring, if he uses AI, does he then not learn the correct muscle? Or does AI just help leapfrog him to a different place?
I think it helps leapfrog, and we all have to sort of obviously be very cautious and think through how we're using AI and keep helping the models learn. We've been talking about the art of the prompt being a new skill that everyone has to learn. Young people understand the art of the prompt.
What's the art of the prompt?
The art of the prompt is the questions that you would ask AI to get a response.
I see. Okay.
So to get the output that you want. And so the better the prompt, the better the response.
What's the biggest headwind for your business going forward? Is there anything structural that's kind of keeps you up tonight, or is it just managing the day-to-day like we all do here with the news flow?
Yeah, look, we talked about trust earlier, right? Trust takes years to build and a moment to lose. So it's the day-to-day, keeping your head down. You can't lose sight of the details. We call it being molecular at BNY. You really have to understand the details of how things work. And at the same time, sort of continue to sort of take a look at what's on the horizon and what's coming next. I talked about private assets. We're talking about meeting with clients the last couple of days. The interest in private assets and how that sort of gets integrated into the custody platform is something that sounds so simple, but really not that simple.
Yeah, we were talking to Emily about that and how the wrappers have changed and how then the offerings have changed. In that area, what's the thing that's most interesting for you?
Creating scale. How can we help our clients sort of grow? Because growth is a challenge. You talk about headwinds. Growth is a great challenge in this industry. Particularly organic growth. And so how can we help them scale their businesses organically, make those sort of mundane tasks sort of go really simply, and how they can sort of take advantage of these new products that are coming to market in a way that's simple for them to use.
Hey, Jim, about 30 seconds left. What's the current state of the trend that it's always been there? I've been on Wall Street since the mid-'80s. Leaving the wirehouses, going out on your own, going independent. Where are we now in that trend?
It's continuing, Paul. It's going to continue. There's a great bifurcation happening in the marketplace. Very, very large to then at the other end, the boutiques. And so I think that's going to continue to be the case. And we hopefully will be a big part of that as the world's #1 custodian.
Yep. All right, great stuff. Jim Crowley joining us here. Jim is the global head of BNY Pershing. Joining us on site here at the BNY Insight in the National Harbor, Maryland. Great place to be.
You were just thinking about the Jersey Shore.
Thinking about the Jersey Shore. I got that on my brain. Exactly. It's always on my brain now.
All right. Coming up, Phil Orlando. We love talking to him, and now we get to see him in person, so it's very exciting. Will be joining us, Chief Equity Market Strategist and Head of Client Portfolio Management at Federated Hermes, as we take a look at a market doing just fine. I say that because I feel like every day we're seeing the tech start to outperform a little bit, but no huge rally, no huge sell-off, just kind of grinding where we are, particularly after you get the JOLTS data and you got the factory orders, a little bit of a mixed bag. JOLTS not terrible, and so equity is holding up relatively well. So we'll break all that down, and how do you manage the volatility, and were the retail investors right? Is buy the dip really how you want to be thinking about this market? We'll discuss all of that and more. This is Bloomberg Intelligence. Happy Tuesday.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Tuesday, everybody. Alex Steele alongside Paul Sweeney. We are live from BNY Insight 2025. We are in National Harbor, Maryland, at the National Harbor, Maryland, at the Gaylord Convention Center for this tremendous event. Over 2,000 people are here. They talk about ideas. They exchange thoughts about the markets and wealth management and private wealth and alternatives. It's a pretty exciting, dynamic place to be. And joining us is one of our favorites, Phil Orlando, Chief Equity Market Strategist and Head of Client Portfolio Management at Federated Hermes. Phil, always good to see you.
Alex, thank you so much for having me back. It's a thrill.
You've been coming to these for a long time, right? So
yeah.
What's the different vibe here this year? Is there one?
The vibe is very optimistic.
Really?
There is more of an emphasis on technology today and AI than there ever has been, but probably it's not surprising given the evolution of the business. I've always found these conferences to be very cutting edge in terms of what are the key issues that are going to be driving us in the months and years forward, and so far I haven't been disappointed here today.
Phil, just looking at the S&P 500, we've almost completely round-trip peak to trough, back up to peak here. What do you make of that? I mean, that was a short period of time. You saw big moves in the marketplace. What do you do looking forward for the next 6 months?
Oh, more to go.
Okay.
I mean, remember, our full-year target for the S&P this year is 6,500. We've got a 7,000 next year. So, yes, we've had a really nice bounce off of that support level. I think we're up about 23%. On the S&P 500, but again, not surprising to us because that waterfall decline was largely a function of the uncertainty relating to the tariff situation, and to some degree, how is the tax legislation going to work? We're starting to get some early resolution of exactly, at least directionally, how that's going to play out. And the market at that point should begin to think about, okay, what are the underlying fundamentals, not the chaos associated with what caused the decline back in, early April.
All right, let's pretend that we can put aside the chaos then for a second. Does that mean that tech continues to lead, or do we get the broadening out?
Well, yes.
I was going to say, or can both be true?
So our feeling going into the collapse was that the rally did need to broaden out. We were de-emphasizing sort of the technology and the Mag 7 names because we felt that they were ahead of themselves. So the area of focus for us was the forgotten 493, the value names, the international names, the smaller cap names. But as the market came down 21%, the Mag 7 names were down 45%. So as we started to put additional money to work, we increased our equity allocation to a 5% overweight near the bottom. That incremental add for us was in domestic large cap growth. Okay. So we recognized that 45% down was actually an attractive point to start to put some money back to work.
With a little bit of hindsight, as we think back to that sell-off in April, a couple of things kind of come to mind. Number one, we had people during the sell-off telling us, people aren't panicking out there. That's number one. And number two, retail is buying. What is that? What do those two things kind of tell you? They kind of, I guess in hindsight, I would have said, boy, I should have been buying there because the retail guys are buying. I don't think I really saw on panic selling. Yeah.
We've done some work looking at the performance of the market literally over the last half a century.
Okay.
And over that period of time, there have been 10 massive declines, 20% or more, 20, 30, 40, 50. And in every instance, that was a great buying opportunity, that over the long cycle, the ingenuity and hard work of the American people, stocks up and to the right. So if you look at those big declines down and think you understand what the underlying fundamentals are, that to us was a reasonably and attractive buying point.
So how do you look at, I know we talked about this before, but how do you look then at the next 6 to 8 months? As you manage the uncertainty, you just be really strategic, you have your buying list, and you think of it that way, and you kind of ignore the actual headlines?
Well, we take a longer-term perspective. We're looking at 6 to 12 to 18 to 24 months. And as we look at that perspective, the noise and the nonsense and the chaos associated with the day-to-day, we sort of screen out.
But some of those things could be structural.
They could be, and if they were structural, we would change our view. But we've got a view that for example, our GDP forecast for next year is 2.7%. All right, that doesn't sound like much, but consensus is 1.3. Yeah. The highest estimate on the street, other than us, is 2%. So we think that things are going to work out over the course of the next 18 months. And if we're right, we want to be buyers of stocks in that environment.
Do we still have earnings risk? I know earnings estimates have come down, but do we still have earnings risk, do you think, out there? Because we still have tariffs that are going to be gradually rolling into the economy.
There's always earnings risk, but we just got through the first quarter, and revenues were up about 5%, earnings were up about 12%. Those numbers were better than expected. We've sort of adjusted our full-year numbers based upon the implementation of tariffs, but that trajectory is still positive.
All right, Phil, really great to chat with you. Good to see you in person. It's so weird when you're just not on a screen. Phil Orlando is Chief Equity Market.
Thank you very much for having me on.
You bet. A Chief Equity Market Strategist and Head of Client Portfolio Management at Federated Hermes, joining us on the markets. We got a second day tomorrow here, Paul.
We do. That's
This is just
cool.
the beginning.
Yeah, so I have a fun day planned in Washington, D.C. Going to go see the Lincoln Memorial, which is one of my faves. Nice. Going to the Smithsonian, got that all booked for 2 o'clock. Then a little dinner in town.
Oh, it sounds nice.
Yep.
I got meetings. I got a hit
See?
on Constellation Energy at 3:40. Anyway, all right. Bloomberg is now, just for those of you who want to know, wait, where is this promo? Our sponsor. Hold on.
BNY Insight.
What?
Oh, you
No,
want that?
for
I know
our
what you want.
listeners.
Yeah.
For our listeners in the U.S., here's a reminder. You can listen to us via satellite radio, Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Ship Station. Stay tuned for the latest market and industry research. We have a Balance of Power is starting up right now, and that wraps it up for me and Paul on this Tuesday. Taking a look at the market, where you have the NASDAQ again leading up 0.8%, and the S&P up by 0.5% as the VIX stays low. This is Bloomberg.
Thank you.
Wow, thanks, Mark.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
The next bill to reach the floor of the Senate will not likely be about tax and spending. It'll be about crypto. Welcome to the Tuesday edition of Balance of Power, as we look ahead to a floor vote as soon as this week on the Genius Act, but only after a showdown over amendments. Today, we present you an important conversation with Senator Cynthia Lummis. The Republican from Wyoming helped to write this bill, is continuing to push for it, and is going to sit down momentarily here with Bloomberg. After the conversation, we'll have insights from Nathan Dean at Bloomberg Intelligence. First, my colleagues Shonali Bossack and Tim Stenivek with the interview with Senator Lummis, live on Bloomberg.
We now welcome our Bloomberg television and radio audiences for a conversation with Republican Senator Cynthia Lummis of Wyoming. Senator, welcome to Bloomberg Crypto. We appreciate you taking the time this afternoon. I do want to start with the stablecoin bill in Congress, the so-called Genius Act that's making its way through the Senate right now. What are the remaining hurdles for the bill, and what do you expect the timeline to look like?
We will start voting on the Genius Act, the stablecoin bill, this week. I don't think we're going to complete it this week. We'll probably have to go into next week because a number of amendments will be filed. But we have worked long and hard to bring Democrats to the place where they can vote for cloture. I think we're there.
So what are the remaining hurdles for Democrats? What have they told you that their concerns are? What's keeping them from getting on board completely?
Well, we have generally agreed to many of the amendments they wanted. There were concerns about illicit finance. We've addressed some of those. And we're just waiting to see what amendments are filed by both parties as we move the bill to full consideration on the floor of the Senate. One of the things that I'm looking for is whether the Durbin-Marshall bill, it will be attempted to attach to the stablecoin bill. It's not about stablecoins, it's about credit card swipe fees, but this bill may be seen as a vehicle to attach, and that would be a heavy lift to take a bill that already has been carefully negotiated and add a new subject that is that controversial.
So just one more on the timeline here for the American people who are watching and listening right now. In your view, what sort of week or month could this bill actually become law?
Well, we're going to pass it next week.
Okay.
And so it will provide new markets for U.S. Treasuries. It will help protect the U.S. dollar as the world reserve currency. It will provide a way for something like a traveler's check to be used digitally. It's pegged to the dollar, so it's sort of it's a payment stablecoin, something that can be used for payments in a digital format. This is going to create more versatility for the U.S. economy and move us into the 21st century.
For the world of crypto and for the stablecoin world as well, it will be historic. I mean, this will definitely change the game. One question I have, though, is the usage. There was a lot of question about the ability, or rather in the most recent lawmaking, the prohibition of interest-bearing accounts, this idea to have individuals hold stablecoins for the purposes of collecting yield. But there's a sense here that this would allow then for tokenized deposits to become a much better vehicle by which the financial system can use crypto to become a depository tool. What do you say to the industry that is still pushing for those interest-bearing accounts?
Yeah, I tend to agree with them, but we can't get the bill passed if that provision is in there. So at some point, when it comes to making sausage or making legislation, you have to count the votes. And the votes aren't there to pass the bill if the interest-bearing provision is in the bill. Now, we're just going to send this bill to the House. And so the House will have an opportunity to work on this bill as well. I suspect that issue will be brought up when the Genius Act goes to the House.
Now, one of the biggest things that you've attached your name to, too, in the world of crypto is, of course, when it comes to the strategic Bitcoin reserve, your push for legislation there. Realistically, how fast can that move forward? And do you think that it will gain traction among various members of even the Republican Party who might feel that selling off a portion of gold reserves, for example, might go too far? Do you think that your bill needs to face some change in order to get it through?
You know, I never proposed selling any of our gold or hard assets. I did propose converting our gold certificates to current fair market value and using those to convert to Bitcoin. That said, I don't think we're going to get to this bill in 2025 because our next priority is market structure, determining what is a commodity and should be under the jurisdiction of the Commodity Futures Trading Commission, what is a security and should fall under the jurisdiction of the Securities Exchange Commission. So market structure is going to be our next focus. We're going to begin that next week. And so we want there to be no interruption between stablecoins and market structure legislation as we continue to move forward.
This is the so-called Clarity Act in the House, the market structure bill. What do you think should fall under the SEC, and what do you think should fall under the CFTC?
Yeah, I think that most, certainly Bitcoin is a commodity. And I think that a lot of tokens are going to fall under the jurisdiction of the Commodity Futures Trading Commission. But if you look at the big organizations that deal in digital assets, the Coinbases of the world, the Krakens of the world, they're going to find some involvement with the SEC in terms of the disclosures that are required by the SEC.
I want to go back to the strategic Bitcoin reserve for a moment here, because your point on fair market value is a fair one. That is something that we have heard others in the market even propose. But when we earlier this year spoke to Treasury Secretary Scott Bessent, it really wasn't in the cards. You had mentioned that the strategic Bitcoin reserve would be something that is maybe not a 2025 priority in terms of the bill due to this other lawmaking, which of course is very, very significant. But given how much the rhetoric for a strategic Bitcoin reserve has come up with the administration, what are the forces that get us there ultimately? Do you think that this is something that will take years to get to because of the disagreement around it? Or do you think that there is a pathway to do this faster?
Yeah, I do think there's a pathway. I think the place to start is to use the money that's held by the U.S. Marshals Service because it was asset forfeiture monies in the form of digital assets. That could be the basis for year one of a strategic Bitcoin reserve. And then we can add other currently held assets held in a different form, convert them to Bitcoin and hold them later. So there are certain things that the administration can do using its existing authority and doesn't need legislation to do. But I think it's important eventually to have a legislative framework for a strategic Bitcoin reserve so it can't be undone by future presidents. And my purpose for a strategic Bitcoin reserve is to set it up, have 1 million Bitcoin, 5% of all Bitcoin, hold it for 20 years, and it will eliminate half of the U.S. debt. So this is a buy and hold strategy to address the debt.
I mean, critics might say it would only eliminate the debt if the price of Bitcoin continued to move higher. And there's certainly, at this point, no guarantee that it would do that. I do want to just jump in and mention that last week we heard from Jamie Dimon, the CEO of JP Morgan Chase. He said that instead of Bitcoin, the U.S. should stockpile rare earths, guns, bullets, drones, planes, etc. What do you say to critics like Jamie Dimon who say this is a waste of resources?
Yeah, I would say that even the United States military disagrees with him, that there are generals, especially in Southeast Asia, who believe it's important to have strategic Bitcoin stockpile because we're doing an economic war with China and we have to prepare for a guns and bullets war. But we need both. And so all we need to do is look to the leadership of the current U.S. military to find support for a strategic Bitcoin reserve.
Senator Lummis, I'm also curious about whether you would advocate and what assets they would be if you were to advocate for assets outside of Bitcoin for a strategic reserve. Is there anything else that fits the bill for inclusion?
Okay, so right now we have a strategic oil reserve. We have, believe it or not, a strategic cheese reserve in the United States. With regard to a digital asset reserve, I think it should only be Bitcoin. And that's because Bitcoin is based on proof of work, not some other means of mining it. And so it's important that we stick with Bitcoin.
Hey, I'm just curious, Senator, how you're looking at the Trump family's proximity and specifically the president's proximity to Bitcoin and to the industry. Our team at Bloomberg News reporting that since the early days of the re-election, the president has essentially doubled his net worth to about $5.4 billion. More than $500 million of that came from sales of just one of his crypto ventures. And then last week, Trump Media, and the president owns more than 50% of the shares of that company, raised close to $2.5 billion to buy Bitcoin for its own treasury. Is it a conflict of interest that he stands to benefit from the price of digital assets going higher?
You know, it's not. Is it a conflict of interest that he owns resorts, that he owns hotels? Those are also assets. The fact that he was foresightful enough to invest in digital assets and that he's making money as a result of that foresight is something that other Americans should admire. People who've invested in Bitcoin have been foresightful. We have modeling that shows that Bitcoin is going to increase dramatically and then more slowly over time. All of the Bitcoin, meaning 99% of all the Bitcoin that will ever be mined, will be mined in the next 10 years. So this asset has growth potential for the next 10 years that's tremendous. I think the American people should admire the fact that President Trump was foresightful enough to engage in the digital economy. Everyone is going to be involved in this economy in one way or another. And I'm proud of the president for choosing to engage in this very promising component of the economy.
Senator Lummis, I want to speak more broadly also about what's going on in the U.S. The big, beautiful bill reaching the Senate here. What would it take for it to get your vote? Are there changes that you would need to see?
There are. I would like to see some reforms to Medicaid. This is not in an effort to remove benefits from those who were intended to have it, but rather to stop the states from using a mechanism to enrich their federal participation dollars. 49 states are doing it. They figured out this little loophole that gets them more money than they ever would have been intended to have. And so it would require the reform of the state's loophole for me to support the Medicaid reforms that are additive to what the House has already done.
Senator Cynthia Lummis, Republican of Wyoming. Thank you so much for joining us live from Capitol Hill on
Pleasure.
Bloomberg Crypto.
Thank you for having me on.
There you have it, live on Bloomberg as we listen to a fascinating interview with Senator Lummis. Big thanks to Shonali and Tim for the conversation live from New York. I'm Joe Matthew in Washington. Thanks for being with us on Balance of Power here on Bloomberg Radio, Satellite Radio, Channel 121, and on YouTube, where you can find us right now. Search Bloomberg Business News Live as we unpack everything we just heard with the voice of Nathan Dean, Bloomberg Intelligence Senior U.S. Policy Analyst, somebody we've talked with, I should say, about the Genius Act, the future of market structure legislation. We just heard, Nathan, welcome back, from one of the authors of that bill, the Genius Act. Seems to think it will not be on the floor this week, but next. Is that true? Will it pass next week?
I actually think it will, and I think Senator Lummis hit it on the head when she called out the Senator Marshall bill, the Credit Card Competition Act, because
she went right for it.
Yeah, exactly, and that's the bill that would, if there's going to be roadblocks to this bill, it's going to be that amendment. Anybody who's flown through LaGuardia or Reagan has probably seen the adverts that this bill, this credit card bill, could put these airline credit card reward programs at risk. Yes, it has nothing to do with stable coins, but it's a bill that puts the banks versus the retailers versus the airlines. And when you get a situation like that, most of the senators just stick their hands up and say, I can't deal with this. So I think that amendment gets withdrawn, and eventually this bill does pass, and I think it goes to the House and it gets done probably late June, early July.
So we have to go through a protracted amendment process, right? Democrats are going to try to make this painful, but you don't see the credit card, the swipe fee bills not going to make it.
No, I think it's just too heavy of a lift right now, especially on a bill that really the crypto industry wants to see this get done. Mm-hmm. And I would also point out is that, there was this discussion about payment for yield, or, the payment. Yeah. Senator Lummis essentially said, look, the House is going to take a look at that. I don't think the provision flies, because that is one of the provisions that I think is a no-go with the Democrats. So I don't think stablecoins are going to be able to pay yield under this bill.
There were a lot of questions about a potential national Bitcoin reserve or crypto reserve. Senator Lummis was quick to slow Tim and Shonali down to say we need a market structure bill first. That's going to be the sequencing, right? If this passes, what does that help unlock when it comes to the Clarity Act?
So the Clarity Act potentially could get a markup next week in the House Financial Services, House Ag committees. This bill is like manna from heaven for the crypto industry. Yeah. I mean, stablecoins is just stablecoins.
This is Fit 21 with a different name, or is there more to it than that?
It's Fit 21 plus a different name. So it clarifies what is a commodity versus what is a security. Yep. Most of the crypto world wants to be in the commodity space, because then you're under the CFTC. Right. They have principles-based regulation as opposed to prescriptive-based regulation. Essentially, it's a little bit more innovative and a little bit less enforcement risk. And that's why this bill, which would actually give the CFTC authority over spot markets, is very much sought after. The challenge with the Clarity Act is that for all the headaches the Democrats were giving in terms of trying to get the Genius Act through, those headaches are even pronounced even more on the Clarity Act, because there was general bipartisan agreement that there is a regulatory gap, if you will, for stablecoins. Yeah. There are still a lot of people like Senator Elizabeth Warren out there that think that 1930s era securities law is good enough for the crypto world, and they're going to be much more difficult to get across the line. I think the Clarity Act doesn't get passed until next year.
Wow. How much of this has to do with the overhang of the Trump involvement, the Trump meme coin, the conflict of interest that we keep hearing has the potential to slow things down? But why?
Well, you don't want to give President Trump a win if you're a Democrat.
All it is?
I think that's partly it. I mean, also there is, within the stablecoin bill, there was a lot of push over illicit finance, KYC, know your customer, AML. anti-money laundering. Any of those types of issues or provisions, I think, can get resolved, especially under the Clarity Act. You know, we're talking about KYC. I don't think KYC usually ultimately disrupts legislation. But the idea for President Trump and his family being involved in meme coin, it's really difficult for policymakers to say that I'm going to support something, support a regulatory framework that allows individuals to put in their dollars when they see meme coins or other bad words talked about meme coins. You know, that makes it a little bit harder for policymakers to actually move forward.
There's going to be no Dogecoin in the National Reserve.
Well, no, and actually I think that was one of the most interesting things Senator Lummis said, is she said Bitcoin only. Only. Now, when President Trump put out his executive order from earlier this year, things like Ethereum and Solana were mentioned. But if it's Bitcoin only, and the United States has a tremendous amount of Bitcoin and Ethereum already due to, you know, essentially just enforcement actions and so forth. But if a strategic Bitcoin reserve actually moves forward with the idea that the United States is purchasing Bitcoin, that leaves the Ethereum Solana out. Maybe some of those traders aren't going to like that.
Wow-wee. Producer James is very upset about the Dogecoin thing. We thought we were onto something. Bitcoin, by the way, up 1.5% over $1,500. We're holding well above $106,000 here. The idea of a national crypto reserve or exclusive Bitcoin reserve would inherently send this price higher, I assume. But what does the country get out of it? Why would we make this investment?
So when it comes to all three of these bills that we're talking about, one way to think about it is, are you looking at it through a retail trader, or are you looking at it through an institutional trader or an institution like Coinbase or Robinhood? Okay. If you're a retail trader, look, you want the United States to be purchasing Bitcoin. You want other people to be purchasing Bitcoin. As a result, the price goes higher. But if you're on Coinbase or in Robinhood, the idea here is just institutional usage. The price is actually somewhat, you know, irrelevant for right now. The idea here is you want people to use more of it. So Washington tends to be looking at this through the eyes of just wanting to get more people to use this, the bipartisan folks between all these bills. It's not thinking about price. So on the retail side, if you just want something that's going to drive the price up, you may have to just keep your, you know, expectations in check, because Washington isn't exactly thinking of that method. They're thinking more about just getting the regulatory framework in place so that institutions and people can ultimately continue to start using it more and more.
I guess that would explain the price here. You running odds on reconciliation? There was a question for the senator at the end. They're going to be tinkering around with this bill in the days ahead. What kind of odds do you have on this bill right now, and how different will it look in the House?
We're sticking our neck out a little bit on this one. We're saying 80% by the August recess it gets done. The reason being is that I just think that because the debt ceiling is included in this bill, and plus, you know, I think the Senate can eventually come to an agreement. You probably won't get Senator Rand Paul. We saw President Trump tweeting him this morning. I don't think you may get Senator Ron Johnson, but you may get the moderates to come on board, because the idea that our thesis is that ultimately this is going to increase the deficit, because it's easier to borrow today for tomorrow's pain than it is to actually take a vote that's going to cut either Medicaid requirements, Inflation Reduction Act requirements, or SNAP benefits. It's much easier to just say we're going to increase the deficit. And I think that's where the Senate goes.
Fascinating. Great and deep dive with Nathan Dean. Many thanks, as always, for the insights at Bloomberg Intelligence, our senior U.S. policy analyst. Having heard a fascinating conversation with Senator Lummis, nobody knows this stuff better than Nathan. So you just heard 80% odds. Does salt make the cut? There are questions about it right now. A lot of people seem to think it will. We're going to talk with a stakeholder coming up. Colin Allen of the American Property Owners Alliance is going to give us his view on all of this, and we'll ask him what's keeping him up at night. We'll also have an update from the North Lawn of the White House. Tyler Kendall with the latest on the big push for the big bill. First, the markets, though. Charlie Pellet standing by at World Headquarters in New York. We haven't heard from Charlie yet. How's it look?
Right now, looking very, very, very green, Joe Matthew. Just about the best level of the day, with the Dow, the S&P, NASDAQ all continuing to push higher. Traders driving stocks higher, as data this morning showed the labor market is holding up despite concerns about risks stemming from President Trump's tariff war. S&P now up at 59.70, up 34 points, a gain of 0.6%. The Dow up 180. 184, up 0.4%. NASDAQ up 171, up 0.9%. And to underscore at or near session highs. The Bloomberg Mag 7 index up 0.8%. The Russell 2000 index is surging 1.5%. 10-year 4.45%. The 2-year 3.95%. Gold down 1%. 33.49 an ounce on the precious metal, while West Texas Intermediate crude up 1.7%. 63.59, and Bitcoin up 1.5% right now at 106,475 on Bitcoin. Earnings news: Dollar General slightly increased its annual guidance after the first quarter top projections. Stock is surging 14.1%. Coming up after the close of trading, we'll be hearing from Hewlett-Packard Enterprise and CrowdStrike. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, great to see you. Thank you, sir. Live from New York, Charlie Pellet, the voice of Wall Street and the New York subway. Indeed, I'm Joe Matthew in Washington. Thanks for being with us here on the radio, Bloomberg Radio, satellite radio, channel 121, and on YouTube, where it's a good time to dial it up. Bloomberg Business News Live. Just search Bloomberg Business News Live. You'll have our live stream there. And welcome if you're watching and listening on Bloomberg Originals. We have a lot to talk about because everybody's back in town today. We told you yesterday, fly-in day. Well, they're already at it. If you're John Thune, you had your feet on the ground here for about an hour before the phone started ringing. Donald Trump indeed hosted John Thune for a meeting at the White House yesterday, and he talked to a bunch of others, too. The phone was ringing. Ask Senator Rick Scott. He came over in person. Rand Paul got a phone call. Oh, boy. And a bunch of talk on Truth Social. You've been following the feed this morning? We're going to get to Tyler on this in a minute. Josh Hawley, Ron Johnson, everybody in touch with Donald Trump, who appears to be the ringleader here in the next phase of this debate. Yeah, this is what they call the big, beautiful bill, the BBB. Tyler toiling at the White House today and joins us from the North Lawn with the very latest on this. Tyler Kendall, the president seems to be obsessed with Rand Paul today, huh?
Yeah, definitely, Joe. And he's trying to ramp up the pressure on these senators who have said that they'll withhold their vote on this bill unless they see some changes. Now, we know when it comes to Rand Paul, for example, perhaps his biggest point of opposition is that this bill will ultimately raise the debt ceiling. Now, we know that the House plan raises it by $4 trillion, but some in the Senate say that there's enough leeway here to raise it by $5 trillion. So there's already some tension there within the Senate when it comes to this. And it's really shows us the conflicting demands that this White House is fielding from senators when it comes to exactly what they want to see ultimately changed in this bill. On one hand, you have this group that are pitching themselves as those fiscal hawks, perhaps Rand Paul, also Senator Ron Johnson, who you mentioned did get a call from President Trump yesterday and says he has plans to meet with the White House's economic team. He wants to see some deeper spending cuts, has also raised concerns about how some of these tax priorities, like no taxes on tips or overtime pay, will they really incentivize growth? Now, we're not expecting those provisions to go away. That's something that the White House is pretty adamant about, but we've heard some Republicans say that they want to make those temporary provisions permanent. So there's really a lot to get into here. And Joe, as you well know, that push for some deeper spending cuts really goes against some of the top concerns from other Republicans that you mentioned, including Josh Hawley, when it comes to potential changes to Medicaid.
Yeah, Medicaid, a big one that we're watching. Of course, Tyler, SALT is as well. It's something that our audience is obsessed with, and there are a lot of questions about whether that SALT deal struck in the House comes back in the same form. Is the president weighing in on this? I notice he has no public events now for a second day.
No, it's really a quiet day here at the White House, so we are still expecting a press briefing at some point later on this afternoon. But it's going to be a tricky needle for this White House to thread because, yes, the Senate needs to pass it, but then they're going to kick it back over to the House, and they're going to have to agree to these changes as well. And you mentioned SALT. I was pretty struck by Kevin Cramer, senator from South Dakota, who joined you yesterday on Balance of Power and said that potentially the sweet spot for that cap could be between $20,000 and $30,000. Of course, we know that the House bill has it lifted to $40,000, and that really was an important sweetener to ultimately getting this bill over the finish line. But perhaps could that come at the expense of some of the other tax priorities that the Senate really wants to get done, including making permanent some of the temporary provisions, including when it comes to businesses. I'm thinking about the bonus depreciation for factories that are made in the U.S. that really go along with the White House's push when it comes to onshoring manufacturing and things like that.
Tyler knows this thing cold. I think she read all 1,000 pages. Beautiful day on the North Lawn. It's 80 degrees in Washington. How about that? Paul Sweeney's got a big day downtown, Tyler. Keep an eye out for him, and we thank you, as always, for the update. Great reporting at the White House from Tyler Kendall. Want to add the voice, as I mentioned, of a stakeholder here. We talk about SALT aid all day long, and if you live in one of the SALT states, well, I guess you are a stakeholder. But sometimes it's interesting to talk to somebody beyond an elected official here, because from lawmakers to lobbyists, this is a big deal right now in the throes of this debate. Colin Allen is executive director of the American Property Owners Alliance and joins me right now here in Washington, D.C. Colin, welcome. It's good to see you.
Thanks, Joe. Appreciate
Did I describe you right as a stakeholder in this debate?
Absolutely. Yeah. You know, we at the American Property Owners Alliance, we were founded in 2020 to represent the interests of individual homeowners and small property owners across the country, right? So SALT is a huge issue for people who own property across the country. You're not seeing, the local taxes go down, right? As home values continue to go up, and local governments look to fund priorities. Sometimes even as you're seeing the federal government shrink what they're looking to do, right? You're going to need to see some of the local governments pick up the slack, and the way they do that is through property taxes. So I know living here in the D.C. area, both the valuation and the assessment went up on properties in the county that I live in this year. So it's been a while since we've seen that, and it's coming to you.
Well, talk to me about what the Alliance is doing. We should be clear. You're a 50C4 advocacy organization, so you can actually engage in lobbying and political activities. Do you have force behind this right now? Are you calling lawmakers about this?
That is correct. We're working to make sure that what we've seen is the House has given us a good provision here with $40,000 in SALT relief. That would cover most of what you'd see from a property owner. And what we were urging is for the Senate to finish the job here.
Keep it where it is. Do you like the deal struck in the House?
The deal in the House is a good deal, and it'll cover, again, what we're looking at here is property taxes for the vast majority of Americans.
Well, listen, if you're lobbying this issue, you know more about this than anybody who's reading or hearing anything. You're on the front lines of the debate. What are you hearing from the Senate? Are they actually going to keep this intact? Because you know what the line is. There's no such thing as a SALT state in the Senate. If you're a senator, if you're a Republican senator, your state's not too worried about this issue right now.
Yeah, so what we're hearing, and I'd say look towards, the person that I've looked to recently is Senator Mark Wayne Mullen from Oklahoma.
Yeah.
Not just because I like what he's saying about SALT.
He's afraid of making big changes as a former congressman, I think, isn't he?
And I think look to him as a good gauge here, right? That he is still very in touch. He's a relatively new senator. Been there for about 2.5 years and still has really good connections with the House leadership, especially on the Ways and Means Committee and the leadership of the House. So I think he is having those conversations and in a really good position to be a gauge for what the House may or may not be able to do from the Senate.
I wasn't kidding when I was talking to Tyler. When we do SALT stories, they become the most read on the terminal. When I talk about it on the air, all of a sudden my terminal lights up. I get email, I get tweets, because so many Bloomberg viewers and listeners understand this story, and so many are impacted by it. If you're living in a state, though, where you do not have high property taxes, and they're talking about a blue state bailout, what's the answer to that? Because this is the debate we're in.
So I think one of the things, and try to illustrate that a little earlier, right, is that as we are continuing to see the value of homes appreciate, right, we're undersupplied, we're not building enough new supply is not coming onto the market. What we're seeing is that the values of homes continue to get more and more expensive. And I'd say as you look to the federal government maybe shrinking some of the responsibilities that they're looking at, a lot of those services are not necessarily going to go away, right? They're going to go to the states, they're going to go to the localities, and the biggest way that those organizations, those units of government fund their priorities is through taxes on property. So I'd say as we continue to see these increasing valuations and local property taxes going up, this is an issue that is going to creep across the country.
Well, you don't only have your ear on this debate on Capitol Hill, you have your ear on the market. That's the reason why you exist at the Alliance. And I want to follow up on what you just mentioned, because it's really interesting looking at the dynamics in this market. And we had new numbers by Redfin that you probably saw. Axios published today. A buyer's market, if you can afford it. There are nearly 500,000 more home sellers than buyers in the U.S. housing market. How long can this last?
So I think, and I was listening, actually, funny enough, this morning on the way in, listening to a podcast with Logan Motoshami from Housing Wire, kind of looking at that, and I think debunked maybe some of the numbers. I think his exact comment was, "I'm going to give this a yellow card." Unclear where that number is coming from, right? I think it may be a proprietary formula from Redfin, but definitely something that you're seeing there. And what we may be seeing is maybe not this like imminent crash of 20 to 40% that I think you'll see some of the trolls on online talking about.
When we use these kind of hackneyed terms, is that not true?
I think we're probably coming back into more of an alignment, right? Where you're having a little bit more supply coming online, and buyers are coming out and saying, hey, maybe I understand that interest rates are not coming back down to 3 or 4%. I'm going to take advantage of where I am. I still have my job is good. I've had a change in my life circumstance, right? We've had a kid, I've gotten married, whatever it is, and I do feel that the time now is right, and that we're in a pretty good.
What would happen?
Situation.
We can't all live our lives around interest rates and whatever. You get a job, sometimes you got to move, or sometimes you need to or want to move. What happens if the Fed starts to cut? What if we get 50 basis points this year or more? What would that do to the market?
I think you would see an immediate interest in folks getting in and buying
People
mortgages,
start listing
right?
and buying. Is that right?
Absolutely. Yeah, no, I think that is very much, some of the folks who may be sitting on the sidelines, right? Yeah. This is one of the things that we talk about on the capital gains side, is that you've got especially older, longer tenured folks who've lived in their homes for a long time, may want to take advantage of getting in there and selling a property if they've been locked in, for a long time, and say, maybe I'll downsize now. It makes sense, where it didn't
in place for a long time.
Exactly, where it didn't make sense at 6.5%, maybe it makes more sense at 5.5%.
You're telling us you think SALT stays where it is when it comes back to the House?
I think it's certainly open for debate, right? I used to be where I came from was that I would start off and say, I think the Senate is kind of they'd take the House bill, send it back, and say, you guys can eat whatever we passed, right?
Yes, exactly. Will the Senate try to jam the House again?
I really feel like you saw this bill
bring the rapture.
You saw this bill pass with one vote,
yes,
right?
Exactly.
I think we're just in a fundamentally different spot here. I feel good. I've heard a number of different things mentioned, but I'm going to follow Senator Mullins' lead on this one and say I think we're in a good spot.
He's part of the driving force behind the SALT cap, keeping it lifted. Colin Allen, American Property Owners Alliance. Great conversation. I appreciate your coming in to see us in studio, Colin. I'm Joe Matthew in Washington. We'll assemble our political panel next on the fastest show in politics. This is Bloomberg.
12:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ continuing to push higher. Right now, best level of the session on the S&P, up 38, up 0.6%. The S&P now at 59.74. The Dow up 176, up 0.4%. NASDAQ up 197. That is a gain of 1%. Traders driving stocks higher as data shows the labor market is holding up. We got more on the day's economic data coming up with our Molly Smith. Right now, the 10-year's yielding 4.46% for the 2-year, 3.96%. Spot gold is slumping $33 the ounce, down by 1%, 33.47 on the precious metal. West Texas Intermediate crude up 1.5%. WTI right now 63.47 a barrel. Factory orders slumped in April, and with that story, here's Bloomberg's Vinny Del Giudice.
Weak orders for business equipment and commercial aircraft contributed to April's 3.7% drop in factory orders, the sharpest since January 2024, based on the Commerce Department report. Factory shipments fell for a second month as businesses grappled with the fallout from veering White House trade policy and persistent inflation. Industry data issued Monday suggests the weakness in American manufacturing persisted into May. Vinny Del Giudice, Bloomberg Radio.
Deal news, Viper Energy, that is the mineral and royalty unit of Diamondback Energy, has agreed to buy Sitio Royalties Corp. For about $4.1 billion. This does include debt in the latest deal focused on the Permian Basin. Shares of Viper Energy, which uses the ticker Venom, VNOM, up now by 4.2%. Shares of Sitio Royalties are surging by 16.1%. Recapping, S&P now higher by 0.6%. The 10-year, 4.46%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
Hey, Charlie, thank you so much. Watching Wall Street for us every day here on the fastest show in politics. The great Charlie Pellet in New York, part of the family here at Balance of Power. A family that also, of course, includes Kaylee Lyons, and she'll be with us about 20 minutes from now as we welcome our global television audience to the program. It was a headline you wake up to that makes you wonder, with all the questions and the predictions that Donald Trump's tariff policy will bring inflation to Americans and will slow the economy. Remember, after Liberation Day, we're running odds on recessions. It was a dark time. The White House says, no, you're wrong. Not inflation if it's a one-time adjustment. And it didn't bring inflation the first time around. What the president's economic policies brought was growth. So if you're talking about paying for the Trump tax cuts, look no further than the first administration. Of course, there are a lot of numbers that would argue with that. But when you see the headline here from the Organization for Economic Cooperation and Development, it makes you wonder. The OECD says, no, you're wrong. Trump White House slashing its global economic forecast due to the president's trade policies, citing the impact of, yes, tariffs, and yes, uncertainty on confidence and investment. So here's where we're at. They forecast global economic growth to slow to 2.9% this year. U.S. rate of expansion expected to tumble to 1.6%. And we had to look up Molly Smith on this because Molly actually cranks out the economic data every day around here, the hard data. Well, I guess sometimes the soft data, too. You do both, right, Molly?
Oh, yeah, every day, Joe.
Yeah. I mean, you do the confidence and you do the... So we got ISM yesterday. We're hearing warnings from manufacturers. You add this now from the OECD. And you know what people are going to say? Hey, why should I believe this Paris-based organization? What do they know anyway? Molly, what would your answer be?
Well, this is a pretty elite global organization of economists, up there with the IMF, the World Bank, in terms of looking at, economies of developed and developing nations. And this, pretty typical for the OECD to look at a global growth forecast every couple of months or so. And this is the second time this year that they're lowering their global growth forecast, with the U.S. to take the biggest hit of all of that. I will say, though, that a global growth rate of 2.9% or a rate of 1.6% in the U.S. is by no means recessionary. It's, consistent with what a lot of economists are saying of slower growth, but not, a complete downturn. So just want to make that distinction there. And what they're saying is very much what we're hearing from businesses too, and what hard data would indicate as well when you make that decision of what people say in surveys versus what their money and investment actually shows, is that that investment is slowing and that confidence has fallen, and that those things together are what add up to slower growth.
Interesting. The OECD predicting the rate of expansion in the U.S., as I mentioned, would tumble to 1.6 from 2.8, globally 2.9. Make a good point. I mean, does this actually help Donald Trump's argument that tariffs don't bring recessions?
I mean, I wouldn't say it helps the argument. It's certainly, when you're looking at a growth rate, more or less falling in half, that's not really,
maybe not.
That's not really helping your case, I would say. But like in terms of saying that this isn't recessionary, at least for now, that seems to be the case. But remember, like so much of what is holding us back from getting to that point is that there hasn't really been a consistent tariff policy in place for the last, really the entirety of this administration, and that it's still very much in the air with the courts and how many tariffs will be in effect and what tariffs can even be in effect when Trump is appealing several court rulings that say that they aren't legal. So that's all of this, again, adding up to this tremendous uncertainty right now. And I think a great point that the OECD made is that even if Trump reverses course on these tariffs, that there's still just so much uncertainty in the air already, and so much investment has been pulled back that it's not like you just then start making multi-billion-dollar decisions, at the blink of an eye. That takes a lot of time and a lot more confidence that the economics landscape is going to be, conducive to that.
Right. I always learn something when I talk to Molly Smith. We got JOLTS today. What happens with the jobs report on Friday?
Right. So the JOLTS data, gosh, I think I hate to trash surveys when I talk about them, since I do look at these all the time, but I would say that the JOLTS survey is becoming of less and less importance for me right now. I think that, when there were so many job openings back in the labor market craziness in 2021 and 22, that's when this survey really was sending the most signal about what was going on in the job market. But for the past year, openings have really stabilized between 7 and 8 million, which is very much in line with pre-pandemic levels. And you can't really say much else about it on a month-to-month basis because it's so volatile, and you get swings of, 500,000 job openings at a time in any given month. So it can be really difficult to look at it from such a micro lens, but on a whole would say that job openings are still pretty stable. That's at least what the case was in April. The employment report that we get on Friday is for May, so can't really compare the two periods there.
Gotcha. All right. That's the truth from Molly Smith. Why don't we plan a meetup maybe on Friday? We'll talk about this jobs report because this is an important one here. Molly, thank you. And it's Bloomberg News economy coverage here. Look for Molly's byline every morning at 8:30. Let's assemble the panel because they've got to take on all of this. This is when the economy becomes politics and politics become the economy. Maura Gillespie is here, the Republican strategist, founder of Blue Stack Strategies, and Kristen Hahn, our Democratic strategist partner at Rock Solutions. Great to see both of you. Kristen, you know a little bit about this. When the economy turns south, everybody looks at the administration. And Joe Biden had an interesting sort of conundrum because the data were strong. I think Jared Bernstein described it this way on our show recently. The vibes were not. If the data start to turn like this on Donald Trump, what happens to his public perception?
Well, I think you're exactly right. It's the economy, stupid, and it's what we can talk about these numbers that are very high level. I mean, we talk about the jobs reports, and you can tell people all day long that things are okay, but if they're not feeling it in their own pocketbooks, they're not going to believe people sitting in Washington or overseas or telling them how they should feel. It's when it really hits the ground. So I think that we haven't seen. I mean, like your reporter was saying, there's a lot of uncertainty around these tariffs and how it's going to impact people, voters, everyday voters, and businesses are not pulling back. They're not lurching forward. They can't make these big decisions. And ultimately, that will have an impact on everyday Americans. And that will certainly have an impact come next November at the ballot box for Donald Trump.
Yeah. Maura, you worked for a Republican Speaker of the House. When you see a headline like this, Trump tariffs hurting U.S. and global economy, OECD warns. Do your antennas go up when you start projecting months down the road looking at the midterms?
Absolutely. I mean, there's still a lot of time before the midterms start, but if, to Kristen's point and what you're talking about, if people don't feel as though grocery prices are going down or life here in America has become more affordable, that will impact what happens to both the House and the Senate, especially. But you also will probably start seeing it for these gubernatorial races coming up here in the fall. You know, you have Virginia and New Jersey, and so that kind of an impact. With that kind of a headline and not having something prepared and ready to go to counter it is going to be a real problem for Republicans who are trying to keep their majorities slim as they may be. But it's definitely going to be a concern. You know, I think, again, it comes down to messaging as well. You know, for a lot of the Trump MAGA supporters, they're going to hold on if the president says, you know, relief is coming and I'm making deals and all these things. So they're going to hold on for a little while longer. I just don't know how long.
Really glad you said that, Maura. Do you know, nobody's talking about this. Early in-person voting starts in New Jersey today. Kristen, we'll have elections before the midterms to start basing some of this on, won't we?
Yeah, and I think it's going to be really interesting to see, you know, what happens in New Jersey and some of these other places. We already saw, you know, what happened in Florida, where, the Republican,
yes.
The Democrats way outpaced as far as fundraising and also well overperformed what they should have in a very, very Republican district. So, you know, we'll have these little spots here and there where we'll be able to take a look and see. And, you know, and I think there's also these gubernatorial races like Maura mentioned with Abby Spanberger in Virginia. And, you know, these strong candidates that are coming through and can they punch past, you know, what normally would be, you know, what Democrats should do in some of these districts that are tougher for them to win.
Yeah, if you're not paying attention to this, you should. Of course, if you're listening to this program, you probably are. But June 10, New Jersey holds primaries. June 17, Virginia has its primaries, another gubernatorial race. June 24, New York City primaries in the mayoral race. Maura, will these all be seen as and reported on proxies for Trump?
I think they will because of how well he performed in these areas, especially, you know, when you look at New Jersey and New York, you don't think of them as being anything but, you know, dark blue, but they're becoming a little more purple. Yeah. And we saw that in the last election. And so this will be the kind of the first test, you know, where the numbers show up for him or not. You know, you're even seeing, you know, largely New Jersey, the Democratic field is pretty stacked. But they're really attacking one another for being too moderate, which I think is a disservice because it's not a reflection of the past election. To go too far left, you're really just saying that you ignored what happened in 2024. So we're seeing that with these ads attacking Mikey Sherrill and things of that nature. So it'll be interesting. I think Republicans are definitely going to be keeping an eye on these races during this month of June.
You wonder what the turnout is going to be with some of these. Kristen, you know what fatigue is like after a campaign that we just endured. When you talk about New Jersey, Virginia, New York mayor might have its own sort of meme quality, but are people paying attention?
I think there is fatigue, but I think that when you have somebody like President Trump, there is a lot of energy as well. I think on both sides, but particularly with a lot of the Democrats. And when you've got somebody like you mentioned, Mikey Sherrill, in New Jersey, who's just such a strong candidate and is so good. It's probably why they're attacking her, right, for being too moderate. But I think that there's something that's in people, and they're you know, it's up to the Democrats to get to them to the polls. But I think there's something just innate about wanting to do something about what you're seeing in this country right now. And if you don't agree with it, this is the way to do it. You go to the polls.
Well, when you back up to what we were talking about, it was the impact of the economy here on politics. We're getting a raft of data this week. Here, Maura, we were just talking about jobs and this looming jobs report on Friday with Molly Smith. Is the White House or the Republican Party at large, I'm not sure there's a difference. Don't think anyone would suggest really there is, projecting the right message when it comes to the economy. Short-term pain, long-term gain, just stick with me a little bit longer. We're going to be walking into a golden age. Do people buy that if they're not feeling good now?
If you're a diehard MAGA supporter, yeah, you're feeling it or you're going to keep that momentum going because the president is telling you to, and he is promising you.
Yeah.
And to them, I think for a lot of them, they trust him. They maybe don't trust their members of Congress, unfortunately, but they do trust Donald Trump. And so he has a stronghold over his voters that he is going to deliver for them. And so they are going to hold on. And I think you've got Congress who is, really mostly focused on this one big beautiful bill and trying to corral the Senate now and getting them, to get this bill across the finish line. And really, Donald Trump could hold that over them, saying, I'm promising the American people relief and this golden era, but unless you pass that bill, I can't do it.
Great to have Maura Gillespie at Blue Stack, Kristen Hahn at Rock. They're going to be back in our second hour. Of course, our great panel as we bring Kaylee into the conversation. She's on the way, guys, and I hope that you are too. Stay with us here on the fastest show in politics. Hour 2 of Balance of Power is on the way on Bloomberg.